things are looking reasonable right now for the equity markets.
The boom is here. The boom is likely to sustain, but so is all the gloom.
There's a lot of volatility under the surface.
We're a bit more cautious coming into September.
We do see the possibility going into the rest of the year and into next year that this market will continue to broaden.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, Bloomberg Surveillance starts right now. Coming into Monday, just short of record highs. Tech stocks pushing higher, building on 3 straight weeks of gains as Anthropic is telling investors revenue surged to $11.5 billion in 2Q. And the hyperscalers are continuing to finance mega spending plans. Alphabet looking to tap the debt market once again.
No matter where you look, because Anthropic is telling investors this, of course, before they IPO, likely this fall. And then Alphabet once again tapping the debt market. Doesn't matter where you look, whether it's equity market, debt market, hyperscalers are going out there and having to raise more capital.
Still trying to tally this up in real time. $25 billion issued this month. $20 billion deal earlier this year. You've had offerings across multiple currencies, and I'm only talking about Alphabet, and it also includes an $85 billion equity capital raise in the mix. They are determined to spend and looking to tap every single pocket of liquidity available to them across every single currency, it seems, around the world.
Yes, Australia is new for their portfolio, but they went through Swiss franc, euros, US dollar. For Australia, though, this is actually very big. For Alphabet, a little bit less so big than some of those other big projects they went through and other big offerings. But once again, and we are middle of August, they already did this just a few weeks ago. So you can see that insatiable demand.
That effort, and it's a major effort supporting this equity market. Tech stocks bouncing again this morning. Equity futures higher across the board. If you check out the bond market, yields look like this morning. 2s, 10s and 30s. Last week was really busy on the data front. CPI, retail sales. This week a bit quieter. 2s around 415. Rate hike bets trimmed. CPI in line with expectations. PPI soft. Retail sales soft. Payroll soft. The Doves are probably feeling better about the situation going into September than they were about a month ago.
They have the data to back their argument now. Will we likely see potentially still 3 dissenters when you have Beth Hammack once again coming out last week, even amidst all that softer data, saying, I think now is the time to act? Yes, but right now the data's on the Dove side, and Kevin Warsh potentially, if he is an individual that wants to stay on hold, the data and the Doves potentially will help him in September.
And that's the story for the front end of the curve. The story for the longer end of the curve gets interesting this week. Fed minutes in the mix, of course. Also, a 20-year bond offering. Bit of an orphan across the yield curve. Left out in a lot of ways. It's going to be a story later this week. I want to turn to commodities and look at crude. WTI around 83. Brent crude around 89. Crude this morning higher by, let's call it around 1% on those 2 contracts we're looking at this morning. Hits to Lebanon from Israel. 1, 2. The US looking to ramp up economic pressure. 3. None of this is conducive to diplomacy right now. And then this story drops from the Journal indicating the Iranians weren't preparing for talks. They were preparing for a bigger fight.
Yeah, that Journal story is really one that's starting to ignite some of the concerns and rhetoric in the region. Arab intelligence officials have picked up evidence, including communications between Iran and militia allies in countries such as Yemen and Iraq, of a strategic shift inside the country of hardline leadership. They're preparing to go after the United States. And it's so interesting that the story dropped when today marks the 60 days, so the end of the Memorandum of Understanding. And we have not made progress when it comes to officially reopening the Strait of Hormuz and, of course, the peace negotiations.
There has been next to no understanding over the last 60 days. Let's put it that way. Crude this morning still close to 90. Brent at 89.50. Coming up this hour, we'll catch up with Lori Calvasina of RBC as tech drives stocks to a 3-week winning run. Sonja Marten of DZ Bank as Japanese bond yields hit a 30-year high. And Dutta of Renmac as Fed rate hike bets continue to ease. We begin this hour with stocks holding close to all-time highs, looking to build on 3 straight weeks of gains. Lori Calvasina of RBC maintaining her rolling S&P target of 81.50, writing, we continue to think of our forecast as higher but not heroic and reflective of the idea that stocks can move higher, though the path is unlikely to be linear. Lori joins us now for more. Lori, good morning. Good to see you.
Good morning.
That's quite limited upside on the S&P compared to where we are right now? What gives?
Well, so look, we update the target once a month, and we last did this at the end of July. So we've obviously had a big move this month. And so we would tell you to go back and look at the end of July when we froze the models. It was actually about an 11.4% return over the next 12 months, which is basically in line with trend. And I would say, as we go through the 5 models, our cross-asset model has been very constructive, looking for plus 8,300. When we look at the AAII sentiment model, that's also been arguing for like a 10% plus gain. Our GDP model is interesting because back at the beginning of the year, consensus was looking for like 1 to 2% GDP early next year. And now what we're seeing in those 2027 forecasts is numbers a bit above 2%. Our economists have also moved to slightly above 2%, and that's also consistent with a 10% plus gain. But we have cautioned people that those upgrades to GDP forecasts came as the war was turning more optimistic in terms of outcome, and that could potentially be at risk of maybe settling back down into a slightly lower range if we had significant war setbacks. So it's something we've got to watch, but we're not seeing any change in the data yet.
Annmarie, no doubt, we'll turn to the war in just a moment. Let's just build on the outlook here and where sentiment is at the moment. Yours is a 12-month rolling target. Yep. Let's just stick to the year-end stuff from the other strategists at the moment. The average is about 78.50 on the S&P 500. Yeah. That doesn't scream exuberance on the strategy side of things right now. Look through the numbers on the earnings side. 20% earnings growth expected. Yeah. We get something closer to 30. That's a major earnings boom. And yet still, quite a limited outlook on Wall Street. What explains that?
So what we've seen in our modeling is that there's a sliding scale between the pressure on the PE and the strength in the earnings. And so we've actually got, we're modeling to the middle of next year. We've actually gone ahead and haircut consensus EPS growth by 10%. And then you've got very, very bullish numbers, but we've said, fine, if you're worried, let's just take some off the top, kind of consistent with what we normally see. But what we're really seeing is that if you look at kind of an elevated inflation rate, if you bake that in, if you bake in a couple of hikes, if you bake in 10-year yields of, say, 4.75, you get some decent PE contraction, which can borrow against, or kind of offset some of that earnings strength. And that's really, I would say what investors are struggling with. The macro crowd, is really in a tizzy over the interest rate environment, right? Less so this week than they were a week or two ago, but still feeling pretty unsettled. Bottom-up equity people are like, yeah, we're watching that. It's like number 5 on the list of things we're worried about because the earnings are so great. But the reality is you have very complex cross currents, strong earnings tailwinds, but you've also got these headwinds on the interest rate and inflation side.
You mentioned one of those complexities being the war. Today is technically supposed to be the 60-day mark, memorandum of understanding. To Jonathan's point, there's been very little understanding. Are clients still asking about this?
So it comes up less, to be honest, than you would think, and I do think there's been some desensitization, but I also think, I joked once many years ago that macro people, we can worry about whatever big pictures we want, but the bottom-up equity people don't pay attention unless their companies are talking about it. And so when we go and look at what companies are saying on earnings calls, I think I went on a rant about this like a couple of weeks ago, but like the first half of reporting season, the companies just were not talking about the war either. And I said, look, you've got, and we put this in our weekly, I don't know if anybody paid attention, but we said, we need guidance from corporate America on how things are going with hedges, how things are going with inventories, because last reporting season, they all said they had at least a couple quarters, to kind of work through. And we said, well, and they also were saying, by the way, they thought the war would go, through the summer or 2Q. And we said, well, 2Q, has passed. Summer is here. Where are we now? I would say the commentary that we've started to see come out the last couple weeks is more and kind of looks, at the idea that maybe some of those inventories or hedges are working off, but others are still in place. So, it feels like we've got less wiggle room, but we've still got some.
So this week we'll hear from Home Depot. We'll hear from Target. We'll hear from Walmart as well. You'll hear from those names across Tuesday, Wednesday and Thursday. Retail sales was really, really soft. How do you expect these companies to guide around the consumer into year end?
So look, I think the commentary we've been continuing to hear is value-seeking behavior, sort of the pressures from the low end creeping up to the middle end. I think largely what we've seen so far from companies has been consistent with this narrative that we've gotten, kind of over the last few quarters, but there were some cracks, right? And if I look at the travel companies, I've been reading those on the team. We split everything up. And, what we've seen is maybe some inconsistent discussions in terms of how resilient that consumer is. So that was one crack we started to notice. And then we had a big restaurant a couple weeks ago say they had actually seen some slowing. So, we're going to have to see what we get. But I would say that the kind of theme of resiliency, I think that's going to be a hard one to break, even as companies are acknowledging, maybe some cracks
happening. Do you think we could continue on 2 slightly different tracks where we've got this massive corporate earnings boom on one track and then this moderating economic macro backdrop on another.
If you look back to 2015, 2016, right, we had the industrial energy recession and the consumer was very strong. So you kind of had two tracks. And I would say we're seeing more and more of that over the past, kind of decade or two, where things are not necessarily syncing up across the board. 2022 and 2023, 2022 we had a tech earnings recession. We had weakness in the rest of the market the following year. So the idea that things can get on different paths isn't that actually unusual for the last decade.
A few weeks ago, people were once again talking about maybe Sell America's coming back. Are you still very committed to the United States?
So, we had seen basically, if you look at U.S., non-U.S. forward PE, like global developed markets within that context, back at the beginning of February, U.S., or end of February when the war broke out, U.S. got cheap. And so you had kind of a buy the USA trade. And we've seen that flip back and forth a couple times. We're basically back to the 5-year average. We don't look expensive in the U.S. yet. I do think we still have that war resiliency narrative. I think the AI trade is back in vogue. And when growth outperforms, you tend to see the U.S. outperform. So I would say things are not as screaming a buy as they were, say, 4 to 6 weeks ago for the U.S. versus non-U.S. But I don't see any impediments right now.
The IPO calendar is going to reopen after we get through a sleepy few weeks of August. Let's hope they're sleepy into month end. Could hear from Anthropic, could see OpenAI later this year. Maybe that bleeds into 27. But there's a big wall of issuance on the horizon. It's not just debt, it's equity too. How are you thinking about those dynamics?
So I honestly try to stay out of the IPO conversation.
Why is that?
Because I'm an equity strategist and I don't like to talk about deals.
Does the supply not matter to you?
No, it's not that it doesn't matter. It's just that I tend to think about sentiment issues in that regards. And we have probably 5 or 6 different sentiment indicators we watch. So we're never going to just pay attention to just one. But what I would say is across the board, I don't see signs of froth. And I also am really trying to stay focused this year on the earnings dynamics. And when we look at an AI basket versus the rest of the market, not even, baking into some of these big companies that may be on the horizon, we just still see a lot more strength in the AI story than we see in the rest of the market.
Earnings have been absolutely phenomenal. Laurie, it's good to see you.
Good to see you too.
Thank you. Laurie Calvasina there of RBC. Equities doing better on the tech side. NASDAQ futures higher. S&P 500 futures up as well. You can see on the screen NASDAQ futures higher by 0.5%. Let's give you an update on news worldwide this morning with your Bloomberg brief. Vonnie Quinn has more. Hey, Vonnie.
Good morning, John. Israeli strikes on Lebanon killing 11 people, including a senior Hezbollah commander. The fighting threatens a U.S. brokered ceasefire and may complicate deadlocked U.S.-Iran negotiations as their ceasefire expires today. Anthropic's second quarter revenue jumped at least 14-fold versus the same period a year ago. The company reported a preliminary revenue figure of more than $11.5 billion. Anthropic is meeting with investors ahead of its potential mega IPO. JPMorgan CEO Jamie Dimon warning UK Chancellor of the Exchequer John Healey against higher taxes on banks. Sources telling us here at Bloomberg, Healey plans to speak with more banking execs in the coming days. This ahead of the government's October budget. And that is your Bloomberg brief. John.
Hey, Vonnie, thank you. More from Vonnie in about 30 minutes' time. Up next on the programme, questioning alliances.
We want them to come and help us with the straight countries that we've helped for many, many years. But they should have been there.
The United States is keeping the whole world afloat.
Up next, we'll catch up with Stephen Cook of the Council on Foreign Relations. Live from New York City this morning. Good morning. Start to the trading week, easing into the week ahead. This is the week ahead. This is what it looks like. On the data front, you'll get some PMI data on Friday, some Fed minutes on Wednesday. Also, a 20-year bond issue in the mix following the 30-year bond issuance last week, which brought the highest yield at issue since 2001 on 30-year paper. The earnings picking up as well on the retail side of things. Home Depot on Tuesday, on Wednesday Target, Thursday Walmart. After the retail sales numbers into the weekend on Friday, just the temptation to talk down the U.S. economy. This came from Bank of America, pushing back to some degree. The share of households paying off their credit card bills in full each month has risen. There is little sign of an acceleration in households drawing upon their savings. The backdrop, according to their Consumer Checkpoint report, I'm going to say suggests resilience still for the U.S. consumer.
And David Tinsley was on last week, and he was talking about how the K is actually converging and how you actually see the lower income cohort keeping up. Where there's a really big gap is just that very top level, that 5% that are making a ton of money when it comes to stock market, et cetera, and they're out there really spending on things like airlines and travel.
They're on a boat somewhere in Europe right now and maybe not participating in this conversation right now. Futures at the moment on the S&P 500 positive by about 0.1%, up by 0.5 on the Nasdaq. In the bond market, 2s, 10s and 30s, yields shaping up as follows. Yields at the front end a little bit lower last week, higher at the long end. We'll talk about that. This move just holds. No real bite in this bond market, even off the back of softer than expected data over the last week. You've still got 30s at 526 and 10s close to 470. Crude a problem as well, still elevated close to 90 on Brent, 89.50 this morning, up at 1%. Under surveillance this morning, questioning alliances.
We want them to come and help us with the straight countries that we've helped for many, many years. We've protected them from horrible outside sources, and they weren't that enthusiastic. We don't need too much help, and we don't need any help, but they should have been there.
The United States is keeping the whole world afloat.
So here's the latest this morning. President Donald Trump ordering the Pentagon to reduce military drills with longtime ally South Korea, citing a lack of support in the war against Iran. Bloomberg's Tyler Kendall joins us now for more. Tyler, good morning.
Hey, John, good morning. Well, President Trump did criticize South Korea over the conflict with Iran, but he also cited concerns around the costs of joint military drills, his own relationship with the North Korean leader. And we should also point out there are now reports that the U.S. would like to see South Korea speed up strategic investments. But clearly, South Korea has been part of those conversations about a potential maritime coalition to help secure the strait. But like most allies, has signaled that it doesn't want to deploy assets until there is more stability. And at this point, we're not getting indications that we're headed towards that. Over the weekend, Iran and Oman announced that they have established a shipping map, what they're calling it, as part of an agreement to govern traffic in the strait, but that won't equate to a full reopening. And we're getting very little indication that there are conversations more broadly happening about that reopening, considering that we saw a risk when it comes to the tensions escalating as Israel over the weekend did conduct a series of strikes in Lebanon, it says was in retaliation for an attack by Hezbollah. That is going to risk the U.S. brokered deal that is seeking to disarm that Iranian-backed proxy group, but also could complicate those efforts for a broader peace deal in the region. And John, that's why we're waiting for any updates from the administration on what that economic pressure campaign is going to look like, including the potential we could see some additional so-called secondary tariffs on importers of Iranian crude or those countries that do business more broadly with Iran.
Tyler Kendall with the latest down in Washington, D.C. One, what does the extra pressure on the economic side of things look like? And two, what difference will it make when we've seen little evidence so far that the Iranians are willing to buckle under economic pressure to change course?
More than 40 years, there have been sanctions on this economy, this regime, and it hasn't actually changed. And we did do a deal with Iran. It took 20 months. And I was reminded recently that it didn't take 20 months because the material at hand to negotiate was so hard. It took 20 months because the Iranians want to drag their feet. And according to the Wall Street Journal this morning, they are preparing for an escalatory measure when it comes to this conflict.
This from the president dropping just moments ago. The number one goal is, and always will be, that Iran cannot have in any way, shape or form a nuclear weapon. Thank you for your attention to this matter, the President of the United States. Here's the take from Stephen Cook of the Council on Foreign Relations this morning, writing Tehran has been unwilling to capitulate under crushing sanctions and massive military bombardment. What makes anyone think new sanctions will compel them to come around? Stephen joins us now for more. Stephen, welcome to the programme. Annmarie mentioned the piece from the Journal. This one line, instead of putting faith in talks, the Iranians took the past 2 months to prepare for a bigger fight. How much confidence can we have this morning in the peace process?
I don't think we should have any confidence whatsoever. There aren't any real negotiations that are going on between the United States and Iran. The Iranians have appointed the hardest of the hardliners to lead the Islamic Revolutionary Guard Corps, the military apparatus, and the besieged militia. So they are digging in for a long conflict with the United States and daring the countries around them to support the United States. They have communicated to their neighbors on the western side of the Gulf exactly what they would hit in the event of renewed hostilities. I don't think we're any closer today than we were even before the signing of the MOU, which actually expires today.
Do you have a sense of how the United States and Gulf Arab partners are preparing for potentially a more aggressive Iran?
Yeah, I think that the Gulf neighbors aren't really of one mind. You have the Saudis, you have the Qataris who are linking up with the Turks and the Pakistanis to sort of put themselves in a more defensive position with the Iranians and accommodate themselves to the idea that the Iranians are going to have control over the Strait of Hormuz. The Emiratis and the Bahrainis would like a more aggressive posture towards the Iranians. However, they don't have the power themselves to force the issue. So there are differences of opinion, but I think that in general, there is a sense that accommodation is going to be the only way if they're going to get the Strait of Hormuz open in a more regular kind of way.
Well, you had the Iranian Foreign Ministry this morning coming out and saying it's their God-given right to have control over the strait and that it's never going back to the old way. That's not going to be acceptable to the United States. So, Stephen, how do they actually reopen the strait?
Well, it is certainly not acceptable to the United States, given that a core global interest of the United States is freedom of navigation. But so far, the president of the United States hasn't been willing to kind of do the things that are necessary to reopen the Gulf. And that would require a much more significant military operation in and around the Gulf that would require landing forces, both on those islands in the Gulf as well as on the shores of Iran proper. And that's something that he's ruled out from the very beginning of this conflict. The strait, for all intents and purposes, is closed. On Saturday, only 5 ships transited through it. Last week, 13 ships, only 10% of the average. Most of those went through the Iranian preferred route. So the strait is closed, and I don't think we're any closer to actually getting it back open without a major change in what the United States is willing to do or Iran's capitulation and the end of the regime there.
We're also expecting, as Jonathan mentioned, new economic pressures introduced from the Treasury Department on Iran. What's left in terms of economically that the United States could start to pressure the economy in Iran?
Yeah, this is one of those things that makes you scratch your head. Iran, along with Cuba and North Korea, is one of the most heavily sanctioned countries in the world. The people who are in leadership positions now really don't care whether they're cut off. Perhaps people in countries like Turkey or the UAE, which have facilitated financial transactions for the Iranians, might care. But the Iranians are in survival mode. And so if they're further economic isolated, and I'm not quite sure what that even means, they're not going to care as long as the regime survives.
Stephen, we're still hoping we can avoid another cycle of violence in the region. If that's the direction of travel, though, what do you imagine it looks like? Do you go back to the chaos of March? Is it the retaliatory strikes, the tit-for-tat that we've seen on occasion over the last few months? What do you suppose the next phase of military action might look like?
Yeah, I think that what we're going to see is continued attacks on shipping in the Gulf. The Iranians have continued to do that. And the proxies, the Houthis, the Iraqi militias, and Hezbollah will try to turn up the heat around the region. Saudi Arabia is in full-on conflict with the Houthis at this moment. We saw that the Israelis and Hezbollah are trading blows, again, despite a framework agreement between Israel and Lebanon that would lead to the disarmament of Hezbollah. So I think what you're going to see is this kind of tit-for-tat escalation, sowing significant chaos in the region to the point where the Iranians are trying to bring American partners to their knees and force them to capitulate rather than the capitulation of the Iranians.
Stephen, it's good to see you, even though we're making seemingly no progress at all. Stephen Cook there at the Council on Foreign Relations. It's that line in the Wall Street Journal piece that the Iranians are preparing for a bigger fight. What is that bigger fight? Is the next phase of military action different to the kind of action we've seen since the end of February?
Do they continue to go after vessels in the Strait of Hormuz? I imagine yes, given that is the big choke point that they know also is very challenging for this administration to keep having that closed. And on top of that, what does it mean for U.S. military personnel in the region in places like Kuwait, UAE, and Saudi Arabia?
Who have been on standby for a long time. 89 on Brent, 83 on WTI. Up next, we'll talk about fixed income. Sonja Marten of DZ Bank as the BOJ rate hike bets push Japan's 10-year bond yield to 30-year highs. That conversation just around the corner. 52-week winning streak on the S&P 500, the longest run, the longest weekly stretch going back to May on the S&P. Coming into Monday just south of all-time highs. Equity futures up by 0.2 on the S&P. On the Nasdaq, higher by 0.6. The Nasdaq putting together a solid run, up around 7% over the last 3 weeks or so. In the bond market, 2s, 10s and 30s. 2s retreating back to about 415. We're down another 2 basis points this morning, supported by softer payrolls, softer PPI, softer retail sales. That's helping out the 2-year, but the 10-year, this gets interesting. Just hanging out around 470. Yields higher through last week. 30s as well, still around 525. We have not had a bond market rally at the long end of the curve, even off the back of that softer than anticipated data.
Yeah, that's where all the problems have been. And we did last week have a 30-year auction. That was decent, but it wasn't that great. Fitch had to come out and reaffirm its credit rating of the United States because there has been all these concerns. And it's a litany of issue when it comes to right now the issues facing the bond market. It's the fact that we have a deficit that also this government wants to expand to. When you look at how much they want to increase things like the defense budget, we are still paying a massive amount on net interest payments. You have the AI build out. There is just a lot more money at hand and issues at play that is driving this debt market and driving yields higher.
And more debt coming to market, of course, later this week. On the Treasury side of things, a 20-year issue coming on Wednesday. It follows that 30-year piece just last week with the highest yield at issue that we've seen going back to 2001. The competition for capital is worldwide, and it's across governments and companies as well. Alphabet, we'll talk about Alphabet a little bit later this morning. In fact, in the next few minutes, we'll talk about Alphabet, also reportedly set to come to market to tap the Australian debt market as well. Let's get into some single names, some stock movers this morning. With more, Yahira stands by. Hey, Yahira.
Hi, John. As Edgar Denny puts it this morning, momentum is back. The rotation that hit AI-linked stocks in July is reversing, with names like SanDisk and Micron gaining in the pre-market. And that was after a stellar week for both those names. SanDisk surged more than 35% last week after its investor day. But analysts tell me that earnings are what's helping drive this rotation back into the year's biggest winners. More than 90% of tech stocks have beaten estimates, according to our estimates here at Bloomberg, giving investors confidence to chase these gains once again. Meanwhile, we're learning more from those 13F filings, and they're really having an impact this morning. We are seeing both Intel and SpaceX gaining in the pre-market after Nvidia disclosed massive stakes in both these companies. $30 billion in Intel. That stake alone has more than tripled in value in just the past 3 months, and nearly $21 billion in SpaceX. SpaceX also getting a boost after we learned that Australia's richest person, Gina Rinehart, bought 8 million shares in the second quarter. And more on those 13F filings. We are seeing these names, Axe Compute, Fuel Cell, and Myomo gaining. And what do they have in common? Well, Jane Street revealed positions in all these companies, but it was a tough month for that firm. Jane Street losing roughly $15 billion in July, marking its first down month in about a decade. That was driven in part by its investment in the AI-focused hedge fund situational awareness and Runway bets in Asian equities. John.
Yahira, thank you. More from Yahira in about an hour from now. On our radar this morning, AI giant Anthropic reporting a massive 14-fold surge in second quarter income. According to documents seen by Bloomberg, the cloud maker is telling investors preliminary revenue rose to $11.5 billion ahead of a potential mega IPO later this year. Elsewhere, Alphabet tapping the debt market once again. Sources telling us here at Bloomberg the Google parent company is seeking to raise nearly $4 billion in its debut Australian bond offering. The move could feature 4 maturities stretching up to 20 years. And finally, the ceasefire between the US and Iran expiring today with no apparent path forward on the Strait of Hormuz. Washington also preparing an economic isolation plan for Tehran. It's not yet clear what additional measures the US will implement.
So the United States is preparing economic measures that they want to go after the regime even more, even though it is hard to find how much more they can go after this economy, given this is an economy that's been under strain of economic sanctions for 40 plus years. Potentially they have to go after things like Hong Kong banks or the Chinese. That's going to be a little bit hard as the president prepares for Xi Jinping to come visit him in September. At the same time the U.S. is doing that, Iran, according to the Wall Street Journal, is trying to go after the United States in a kinetic warfare way, rebuilding its infrastructure, according to the Journal, restoring access to its military bases, and it wants to go after U.S. bases and retain that firepower to go after vessels as well in the Strait of Hormuz.
What's clear in the Journal piece this morning, and they've highlighted it, and a lot of people assumed it anyway, the Iranians never had much faith in the peace process and used this as a window to do what they thought the Israelis and the US themselves were doing, which was restocking, reloading and getting ready to strike again.
And it comes at a time, and we've been discussing on this program, that the United States, according to a lot of reports, is running lower on inventories when it comes to our stockpiles of munitions. And there's also been some changes, or we're in the middle of some changes in terms of our posture in the Middle East. We have right now an aircraft carrier from the Pacific having to go to the Middle East to relieve some sailors that are on one that are going to potentially come home to the United States. So there's a lot of moving parts right now, and it does seem like the Iranians want to take advantage of that. When you have the Gulf, which is not a monolithic, you have the Gulf basically having different views. Some want to ramp it up and close this period and get it done once and for all, and others definitely want to see peace agreement at play.
It's difficult to break out of this uncomfortable new normal in that situation right now. 89, close to 90 on Brent, around 83 on WTI. Let's turn to Japan and talk about this bond market. The country's 10-year bond yield pushing to the highest level in 30 years on growing bets the BOJ will raise rates in the coming months. Japan's seeing a surprise slowdown in growth for the second quarter, complicating messaging on the timing of its next rate hike. Sonja Marten of DZ Bank joins us now for more. Sonja, welcome to the programme. I don't want to talk about intervention. I'd like to talk about fundamentals. You've got deficits, you've got rate differentials, and you've got a terms of trade shock. The Japanese can do something about two of the three of those. Do you expect them to do anything at all in the coming months?
Well, I mean, the market is obviously speculating that the BOJ will pull forward its expected rate hike to September. I think there's currently about an 80% probability of that happening priced in. And that could maybe do something. But the problem is the BOJ has a history now in recent years of delivering what we refer to as dovish hikes. They hike interest rates, but the messaging that accompanies these rate hikes tends to be somewhat dovish. They're very cautious. They're very afraid. They were afraid to start off with to trigger higher bond yields. Now they already have higher bond yields, and they obviously don't want to risk pushing that further. So that always gets a bit of a confused message across the markets that may not help the yen. And then, as you said, they have an expansionary fiscal policy, which is being viewed with considerable concern by investors. I read this morning in a German newspaper that this might be a Liz Truss moment in rates. So we'll see how that plays out. But with those fundamentals still in play, expansionary fiscal policy, cautious monetary policy approach, and as you said, now a growth rate that has been that has disappointed expectations, it's going to be very difficult to turn the yen around.
Sonja, as you know, and we've all experienced, the BOJ balance sheet is loaded, it's bloated, it's full of Japanese debt. There were days over the last decade where the 10-year bond didn't even trade. I remember those headlines, I'm sure you do too, crossing the Bloomberg terminal. It wasn't much of a market at all. How much control do they have over developments at the longer end of the curve?
Well, I mean, they've obviously, again, have this history of managing very carefully the yields, and that history is that is now history. They are no longer really able to do this. And so in a way, they've been trying to, I think, navigate a very cautious path towards normalizing this market. But it kind of seems to be getting out of their control. And I think at this point, they're really out of options here. I don't think there's much they can do. And as I said, especially with a view to what many perceive to be irresponsible fiscal policy, it's going to be difficult, to really control this market anymore.
Jonathan was right to start on the fundamentals, because many are basically saying that the yen intervention from the United States didn't work. At the same time, Sonja, could you see them doing it again?
Oh, yeah, absolutely. I mean, I think the message is quite clear that they're willing to act again. And I think the message from the US has been quite clear, and that they will support Japan in those efforts. And to be honest, if you're talking about concerted intervention from Japan and the US, then I do think they have the necessary firepower to stall dollar yen on the upside. If you just keep at it long enough, you're going to scare away any speculative investors. But that is not the same thing as saying that you can turn it around. It's one thing to maybe put an upper limit on dollar yen. That may be possible, but you're not going to achieve an appreciation of the yen that way. You're just going to prevent it from falling further.
Sonja, do you see this as a Japanese issue or a global bond market problem?
Well, I think one leads to the other. It is a Japanese issue, but it doesn't have an impact on the global bond market. I mean, for years now, investors have been speculating on the impact of high yields in Japan on the global bond market, and to the extent that, as we all know, Japanese investors are heavily invested in foreign bond markets in the US, in Europe, and that rising yields in Japan may trigger a repatriation flow that could then push bond yields higher elsewhere. And we've seen that to some extent. If you look at the latest portfolio flow data from Japan that came out last week, Japanese investors have been net sellers of US bonds, not massive amounts, but it's still a bit of a change in the trajectory. So it's both. It's a Japanese issue, but it has a potential big impact on global markets.
Well, let's just sit on the global bond market problem, but the potential for one. You mentioned Liz Truss. I know people love to throw around that name, but I think we can talk about the dynamics that people are trying to allude to when they mention her name, is that you get to a point in developed markets where high yields beget high yields, and that you need some kind of corrective action from fiscal authorities. Do you think we're close to that moment in DM, given the massive competition for capital that we're seeing worldwide, not just in sovereigns, but increasingly from corporates too?
Yeah, I think definitely it's an issue that, for the last couple years that has gained a lot more traction. There's a lot of talk about bond vigilantes, and we have seen situations in many countries where yields have pushed. I mean, we had situations in the US where we've seen this happening a couple of years ago when they lost their last AAA rating. It was an issue, and it keeps coming up again and again. The problem, I think, in terms of forecasting is that it's really difficult to define the trigger point. At what point does the whole thing get out of control? And it's impossible to forecast this, obviously. But we are certainly in a situation right now where this is a major issue for the market, and people are getting very nervous. And so discussing bigger budgets, bigger spending, bigger defense spending, etc., it just adds on to this fear. And as you say, at some point, it becomes sort of a self-fulfilling prophecy. It's an unforgiving bond market right now, that's for sure. Sonja Marten there of DZ Bank. Sonja, thank you. We've seen this increasingly, the biggest companies on the planet levering up. Maybe I'm sort of stretching the use of that term right now, but increasingly taking on more debt. Cash flow negative. We're seeing that across a number of tech firms in a way that we've never seen before with the tech firms we're talking about every single day, the likes of Alphabet, for one. Then you've got Germany losing its fiscal discipline, Japan finally getting what it looked for, and now they don't know what to do with it. They searched for it for 20, 30 years and finally get the inflation they wanted. They don't know what to do with it or how to handle the fallout from it in the bond market. And we all have to grapple with that right now. The consequences of this competition for capital, I think, is the dominant, the most important theme taking place in global markets.
Yeah, absolutely. Massive competition, especially a lot of this is because the AI companies are stepping in, and also how many countries are having to go back to the debt market to finance defense spending, because we are in the middle of multiple conflicts right now around the world. Let's get you an update on news worldwide this morning. Let's get to your Bloomberg brief. Vonnie Quinn has more. Hey, Vonnie.
Hey, John, thank you. President Donald Trump telling the Pentagon to reduce joint military exercises with South Korea. The president signaling the longtime ally has not provided enough support for the war with Iran. He also cited his, quote, very good relationship with North Korean leader Kim Jong-un. Alibaba is selling its gaming arm to TrueStar Capital in a deal valued at more than $1.5 billion, shedding a non-core asset as it pivots to AI and cloud computing. The sale comes after the Chinese e-commerce giant released its biggest ever AI model and ahead of earnings this week. Ferrari's first all-electric car sold for a record-breaking $40 million. The Luce became the most expensive new car ever sold at an auction. The car maker is expected to sell out of its initial run of several hundred units. And that is your Bloomberg brief, John.
Vonnie, thank you. I'm not going to trust anything with regards to this car. And I'll tell you what I mean specifically. It's not that I don't trust the numbers or anything like that. I don't trust the motivations behind the numbers. I don't believe that anyone truly believes that car is a desirable vehicle. Maybe some people do.
Oh, you don't think it's worth $40 million?
I don't believe every purchase is driven by desire for that one vehicle.
Not.
It's about getting in with Ferrari.
It's like a Birkin.
Stand in good favor.
Yes, you clearly want another car that they make. So you go out and you do this because it means a lot for Ferrari, and Ferrari clearly does not want this to fail.
Unless you're watching this morning and truly you find that desirable and you did stump up that kind of money, write in, let us know.
Well, Sotheby's hasn't released the name of who bought this, so I really want to know.
Was it John Elkann?
That would be funny.
That's
this story, when I saw this story over the weekend, the first thing I thought of was John, and I imagine we're going to talk about this Monday morning.
Right. Up next on the program, let's talk about interest rates, pricing in, complacency.
There's a little bit too much, call it complacency, around the definitive idea that they're not going to hike.
Up next, we'll catch up with Dutta of Renmac, who this very moment writes in the Bloomberg terminal, AMH knows a thing or two about Birkins.
Not true.
Dutta up next. Equity futures this morning positive by close to 0.2%, just south of all-time highs coming into Monday. Advancing again this morning on the tech side of things. Nasdaq futures higher by 0.6. In the bond market, a focus at the front end of the curve. Twos around 415. Yields down a single basis point following last week's rally, just adding to it on the margin. Under surveillance this morning, pricing in complacency.
Our call is that they actually will stay on hold in September. But it's not clear to me that what the market is pricing right now is the story that Warsh wants the market to take into the FOMC meeting, as in there's a little bit too much, call it complacency, around the definitive idea that they're not going to hike.
Julian confusing me this morning. We don't think they're going to hike. The market doesn't think they're going to hike, but that's complacent because Chair Warsh wants you to think they're going to hike. Did I get that right?
Yes.
Okay.
Chair Warsh wants to make sure that through rhetoric, that inflation expectations are under control. So I think that's why he wants people to think they're going to hike, even though everyone knows he doesn't want them to hike because he was given this job by the President of the United States.
Got it. I'm up to speed. I was away last week. I'm struggling to catch up. This came from Dutta of Renmac. He says the following. The market currently sees a 1 in 3 chance for a rate hike in September. That strikes me as low. That being said, if they can't get this done by September, it is not happening this year. Neil joins us now for more. Neil, welcome to the program, buddy. Good to see you. Why only 1 in 3? And why do you believe that's too low?
Well, I mean, I think you have to look at the June FOMC minutes where the Fed laid out sort of a 3-point checklist in terms of getting inflation back to 2% soon, right? They talked about Mideast tensions, AI-related demand, and tariffs. And I'm not sure why anyone is particularly confident about any of those 3 things. I mean, the demand for AI remains insatiable. We see that every day in the capital markets. I think importantly, if you look at oil prices, yes, WTI has kind of settled down a bit, but when you look at crack spreads, I mean, they're very elevated, right? So that ultimately what the Fed's going to care about is what are people paying for energy goods? And refining capacity has been taking out, and that's pushing up refining margins quite substantially, which is why people don't really see the drop in oil at the pump, and why businesses don't really see it in some of the refined products that they use, like diesel. And then lastly, with tariffs, it's sort of a mixed bag. I mean, you can see that in the last sort of CPI data. Some areas that are sensitive to tariffs are down, some are up. And I think it's also, you have to think about the committee dynamics, right? I mean, 6 of these people that want a hike have multiple hikes baked in. So does anyone really think that they're going to, go away? I sort of think that if they don't get it done by this year, what you'll see a lot of those people do is just push hikes deeper into the baseline path. And I think that might be what markets are missing. So even though the doves kind of win the battle, they can lose the broader war, because so long as inflation is running above 2 and the unemployment rate is low, the markets can't price in cuts. That's not going to happen. So all you can really do is have an extended hold or price in that right tail, which is some kind of catch up with rate hikes later. So that's sort of how I'm seeing it. I do think the markets are probably keying a little bit too much off the last inflation print. Let's be clear. I mean, if you look at the consensus for core PCE, you have some people out there that think it's consistent with basically over 2.5% annualized inflation. So I don't think we're really out of the woods just yet. And so, the other important piece of information is the fact that the unemployment rate is tracking well below the Fed's estimate for this year. So if you think about in the absence of a reaction function, you have to kind of go on what the Fed's done historically. And the decline in the unemployment rate matters a lot in terms of those sort of Taylor rule formulations. That puts about another another hike and change into the baseline outlook for this year. So, you have lower unemployment, and inflation isn't really doing enough for the Fed to reconsider what their estimates are going to be for this year.
So, Neil, I think we saw some evidence of what you describe going into the weekend, that we had that softer payrolls print, PPI print, retail sales, and even the likes of the Cleveland Fed President Beth Hammack, still hawkish, still determined, seemingly, to raise interest rates. And I think that begs the question for the next couple of weeks, the runway into the September meeting, Neil. We'll get another payrolls report on the 4th. We'll get a CPI report a week later. Just how relevant is that data to the hawks going into that meeting?
Well, I think it's relevant. I mean, you can see there's good reason to think that the payroll number at least rebounds. I mean, to the extent that we had a negative number, a lot of that was kind of narrow in scope. I'm not saying it was a good report, but this is kind of the vagaries of the data. I don't think we're going to see another 50,000 drop in local government employment and leisure and hospitality. So, that probably rebounds. And with respect to inflation, I mean, there's a lot of moving parts, but at the end of the day, is core inflation getting back to 2% soon? I mean, you have to find a new definition for the word soon. It seems to me that even with the changes the BEA is going to make to the methodology around core inflation, PCE inflation, you're still talking about inflation running well above the Fed's target, closer to 3%, frankly, than 2%. It doesn't mean that inflation won't come down, but is it coming down quickly enough for the Fed and for the hawks that are making the case for hikes? I don't think we're there yet.
Neil, as you said, there's insatiable AI demand, a ton of money being spent on that. There's a conflict in the Middle East. Would rate hikes actually help when it comes to all of these issues?
I mean, it's the Fed's job to balance supply and demand, right? So at some level, yes, it would help.
Oh, okay. So if some level this would help, then what does this do, Neil, to the lower end of the income cohort, especially someone like you who's focused on housing? Does this just make it that much harder for mortgage rates and individuals to get on the housing ladder?
Yes. Yeah, I mean, yes, of course. I mean, it would. That's the whole point, is to slow growth down.
Neil, you say it would help them. Can you just sort of elaborate?
Well, no, there would be pain that would be required. It would help the Fed achieve its goals, is what I'm saying. If the goal is to get inflation down to 2%, then yes, rate hikes would help. Basically just saying that, this is all stuff that we can't do about. I mean, I think I even heard them say, Mary Daly make the argument that, that the AI story could be a supply-driven one. I mean, it's a demand story too. So again, the Fed's job is to kind of take all this on board and kind of balance supply and demand. And, at some level, I mean, the fact that nominal GDP growth is running very strong is a sign that the nominal demand sort of anchor is probably a little bit too high. And so that's why you need the Fed, at least the hawks would say that that's why you would need rate hikes. So in their mind, of course, I mean, raising rates creates pain. And the point at some level is to do that, to slow the economy down and bring nominal demand closer in line to the Fed's broader inflation objectives.
Neil, thank you, buddy. Appreciate it. Neil Dutta there of Runway on this Federal Reserve. And to Neil's point, had all that softer data over the 1 week on retail sales, PPI, on payrolls, and the hawks still sounded hawkish going into the weekend. Up next, we'll catch up with Chris Harvey of CIBC, Ed Mills of Raymond James, CJ Muse of Cantor Fitzgerald, and Steve Major of Tradition. The second hour of Bloomberg Surveillance just around the corner.
There is nothing good about fiscal policy in the US, but that has been the case for a long time.
Financial conditions are as the loosest that they've been this entire century.
I don't think there is nearly enough here for the Fed to say at this stage, we're not going at all this year.
When we look at the interest rate dialogue around maybe rates are higher for longer,
the Fed would likely take its time, staying on the sidelines.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning for our audience worldwide. The second hour of Bloomberg Surveillance starts right now, and your price action, the scores look like this, adding to 3 weeks of gains on the S&P, coming into Monday just below all-time highs, up 0.1% on the Nasdaq, up by 0.55. In the bond market, 2s, 10s and 30s, a bit at the front end of the curve in the last week. Inflation data, not scary enough to push yields higher. Retail sales softer, payroll softer, twos back to 416. At the long end of the curve, just hanging out around 470 on 10s. On 30s, around 525. There is a problem at the long end of the curve, not just stateside, but worldwide. Stateside, we're looking ahead to this week. This week right here, retail earnings throughout the week. We'll hear from retailers including Home Depot on Tuesday. On Wednesday, we'll hear from Target. On Thursday, you'll hear from Walmart.
I'm excited for Walmart because when we last heard from the CEO in June, Doug McMillon, he warned that higher fuel costs were weighing on profit, with prices potentially rising if the pressure persisted. So were they able to hold off in terms of increasing prices for consumers because of what is going on under the hood when it comes to supply chains and the need for diesel and gasoline? Or were they able to hold on to some of those cheaper prices that we know even the upper echelons of society are flocking to Walmart
The
for?
squeeze in energy is a feature of the conversation for sure. Brent this morning still close to 90. We're at 89. The MOU was meant to last, 60 days?
Expires
60
today.
days is up today. Let's talk about the U, the understanding. There ain't much understanding right now, is there?
And it feels like the gap is getting even bigger between Iran and the United States. You have Jared Kushner in Israel. You have potentially the United States wanting to do some sort of deal because they are desperate for the Strait of Hormuz to be open. At the same time, according to the Wall Street Journal, all of this time during those 60 days, what Iran has been doing is rebuilding the infrastructure needed, the munitions needed to potentially have a more aggressive, kinetic fight with the United States, not an understanding of peace. But this would be going back to those early days of the war.
That's the line that jumps off the page from the Journal this morning. Instead of putting faith in talks, they took the past 2 months to prepare for a bigger fight. Coming up this hour, we'll catch up with Chris Harvey of CIBC on why there's still upside into year-end. CJ Muse of Cantor Fitzgerald joins us, staying all in on Nvidia going into next week's earnings. And Steve Major of Tradition Dubai, as Wall Street is slashing rate hike bets. We begin this out with stocks trading their all-time highs following 3 straight weeks of gains. Chris Harvey of CIBC maintaining this year-end price target of 80.20, writing, the path of least resistance continues to be high. Investor sentiment is increasingly positive, but in our view, not enough to be a contra-indicator. Chris joins us now for more. Chris, good morning.
Good morning.
Kind of crazy, isn't it? Everyone sounds like they're super bullish, and then you go through the forecasts on the street right now, and the average is 78.50, which is basically where the market is.
Yeah, so people have been a little slow-footed. People have been not so optimistic this year. And then I'm hearing things like, well, we got to worry about things. You just had a clearing event. You don't need to worry about things until we either get to Nvidia or Jackson Hole.
Can I just pick up on that?
Yeah.
I believe you're alluding to situational awareness.
I am.
Why do you believe that's a clearing event for this market? You're not alone, others do too. Just explain why.
Yeah, so what do we have, right? We came into July and everyone's saying to me and probably to you, hey, this is seasonally strong, seasonally strong. No, that's just an anomaly, right? There's nothing seasonally strong about this. So expectations were too high. If you looked at momentum strategies, they were exceptionally overbought. You come in and what happened? You corrected the overbought situation in momentum. You had hedge funds de-risking, and de-risking created more de-risking. And then you had a situation where you had a distressed portfolio that was bought. Right? Now you take away that overhang. It wasn't fundamentally driven. It was levered ETFs. It was expectations. It was optimism. We corrected a lot of that situation. In addition to that, we reset expectations. And then when you take a portfolio out like that, certainly feels like long-term capital to a degree.
So what do you think you need to step into with that in mind?
So what I think is really, I'm not too worried about what sector you are. What I want is better balance sheets. I want good stewards of capital. I want positive price momentum, and I want the fundamentals to be increasing. And you can find that right across the board in tech, in industrials, and consumer.
Right. Do the hyperscalers offer me better balance sheets?
Some do, some don't. So if you ask me about what sectors and you push me, I'd say we're looking at things like the housing market. We're looking at alt managers. We're looking at the telecommunication sector, which has some hyperscalers. Right? What we're looking at, too, is who's able to come to the market and issue at pretty good rates. And some of those hyperscalers, despite what you're hearing, are able to come to the market at concessions of maybe 10 or 15 basis points, which is nothing when you're doing $25 billion at a clip.
And they're going to keep on coming to market.
Yes.
And we're seeing it with Alphabet this week. Who does it squeeze out? Who pays the price for that?
Yeah, so John, that's a great question. What we're seeing is August is an exceptional month, and August may be a record month. So I think what's happening is most of the other companies are starting to get a little bit of fear that they're going to be squeezed out, which is why August is so aggressive at this point in time. But what we're seeing is the old Alan Greenspan, too many dollars chasing too few assets, believe it or not.
So look at what's happened with bond markets over the last month. You noted it in your research.
Yep.
It's an important point. All that supply,
right.
Spreads are what, a basis point wider on investment grade?
Yeah.
They're tighter on high yield.
Yeah.
What does that tell you?
That tells me is the appetite for risk is still exceptionally strong. People believe the fundamentals are good. They believe the economy. If you go back to the banks when they reported, they were saying the consumer is good to better than expected. The economy is good or better than expected. And that's what you're seeing. And that's what credit spreads are telling you, too.
Can we go through the wall of worry for the second half of the year? The Financial Times just posted a story about how investors in data center campuses face billions in underinsured risk as insurers balk at the cost of full coverage. If there was, like, say, a catastrophic event. That is just one sector when it comes to AI, not the fact that also we don't know what the Federal Reserve is doing. And on top of that, we have global conflicts that continue.
Yeah, I actually think that the risk is we're going to build systemic risk. Right? We're not there yet. So we just had a massive deleveraging. And what do risk takers do? They take risk. So we're going to be in this re-leveraging part. So a lot of the issues, there's a time to be worried. Now's not the time to be worried. In the short term, it's time to be a little bit more greedy and because you had that event. Longer term, yeah, I'm worried about the systemic risk, but we're not there yet.
What about ahead of the midterm election? It's always a bit odd on election years in terms of how the S&P 500 trades.
It is a little bit odd, but as I talk to people, what they're saying is, hey, the House is the Dems to lose, the Senate is the Republicans to lose, and so there's not a whole lot of uncertainty. Really, when there's a ton of uncertainty, that's when we have to worry about it infecting the markets.
Bank of America's Michael Hartnett had a note out last week about how if the Democrats do win the House, we can actually knee-jerk reaction to the downside in equity markets, but you're basically saying it's priced in.
Yeah, I don't know about that. Right, I worry more about the fundamentals. Right, is what happens at Jackson Hole. What does Nvidia say in a week or so? When we come back in after Labor Day weekend, how do all the conferences go? What are the expectations? I'm more worried about the fundamentals than what happens when people go to the polls.
I feel like you're working through the struggle I'm working through, which is called midterm avoidance. Am I in the process of midterm avoidance right now?
I mean, I'm going to be away for 2 weeks.
August 17th.
So you're going to have your time to not talk about. When I come back, I am ramping it up.
Look, I'm right there with you when we get to a certain point, but I'm really trying to avoid it in the middle of August. You mentioned the rising systemic risk.
Yep.
The kind of market where you don't want to be greedy. Can you just spend some time describing what that begins to look like? Help us understand what's on the dashboard, what to look for.
Right. So it's what we were talking about before. The credit markets are wide open. People are levering up. They have the ability to add more leverage. But what we want to do, and one of the key insights is, when does that credit market start to push back? When do they say enough is enough? And you see a little bit of it, just not enough. Because once the credit markets become more selective, we have to reprice risk. Right? Suddenly, we can't do $25 billion at a clip. We have to do less. And suddenly, that CapEx, which is driving everything, which is driving the excess EPS growth, starts to wane, and that growth story begins to wane as well.
We see some early signs of that at the long end of the sovereign curve. 10s, 30s, etc.
Yeah, what I worry about in the bond market is that real rates, especially at the 10-year level, close to 250, that's a really healthy level. If you get above that and you continue to trade up, that's very, very restrictive. And that's telling you that that's not a good time to have risk product on.
This is where people are struggling, I think.
Right.
And I think it's generational dependent at the moment, at least. I think if you lived pre-GFC, if you were in this market, you might view these yields as a normalization, maybe reflection of economic strength, at least in the US. Japan's clearly got its own problems. Do you see it that way, or do you see it differently?
Yeah, so that's a bigger, broader question, right? What do higher rates mean? Do we have to worry about higher rates? Because if higher rates come with higher growth, we probably don't have to worry about it that much. To answer your question, is there a normalization? Yes, I think we already went through that normalization. Now the question is, at what level will bond players step in, and do they believe, right, inflation expectations are stable, and that real rate that they're getting is going to be there and not eaten up by exceptionally growing inflation expectations, right?
Chris, it's good to see you.
It's good to see you too.
Thank you, buddy. Chris Harvey of CIBC. Fantastic note to start the week. Just noting on the data dependence or lack thereof of the Federal Reserve. Kind of odd, isn't it? Data came in softer, right? PPI, retail sales payrolls, and the hawks are still hawkish into the weekend.
The hawks are doubling down. That data came out, and Beth Hammack was at a conference, and she was saying that it's time to act now. I think what is obvious, and Goldman had a note out about this as well, what is obvious is that the data has been so soft that maybe those 3 dissenters are going to dissent once again in September, but they are not adding to that list. The doves will remain on hold, and they haven't convinced anyone to come to their side.
You noted this in the commercial break, and I'm sure you're happy with me sharing this, following the conversation with Neil Dutta, who said something similar. You're not seeing enough in the data to get the doves to cross the line to join the hawks, to get the sufficient numbers behind a hike in September, at least based on what we've seen so far.
And then October is going to come, and that's ahead of the midterm election. If you were to hike ahead of a midterm election, that would look incredibly political, I think, especially given the environment we are in with this president. So what? They remain on hold at least to the end of the year.
Can we just bring up crude just quickly? So we're still elevated here. No big moves. We're up to about 89.90 on Brent crude, high by 0.8. Likewise on WTI around 83. That's where we've been over the last few hours or so for energy, for oil this morning. Just some headlines crossing regarding the president and his thoughts on developments in the Middle East.
Yeah, so 2 things come out from his conversation with the reporter from Fox, that there's a back channel with the Iranian Revolutionary Guard officials, and the president is saying he's in, quote, no hurry. And then this, he warns if Oman gets in the way, he's going to bomb them. Not the Iranians. He's talking about the Omanis, which are working right now with the Iranians to try to open up the Strait of Hormuz. Oman's one of those countries that plays with both sides. It obviously has very close relationships with the Iranians. If you're in Oman and you go out on a boat, you can actually see the Iranian coast. At the same time, it does have a good relationship with the United States.
Just look at that board. Just sit on that board. And just look at that headline.
Doesn't make sense.
Right? How desensitized is this market? Any other president at any other time saying these precise things, you wouldn't see moves like that in crude.
Yeah, we are conditioned to shrug off a lot of these headlines, even though they are coming from the President of the United States. I mean, he's literally saying if Oman gets in the way, we'll bomb the expletive out of them. Normally, if we were in different times, historically, you would see a massive spike. But here, everyone is just ignoring this.
Unmoved, Brent crude, 89. WTI, around 83. Let's get you an update on news worldwide with your Bloomberg brief. Vonnie Quinn has more. Hey, Vonnie.
Hey, John, thank you. Iran's hardline leaders are preparing for a wider war. The Wall Street Journal reporting Tehran has utilized its temporary ceasefire with the U.S. to prepare for a bigger fight by ramping up missile production, appointing hardened veterans, and expanding domestic counterintelligence operations. Anthropic's second quarter revenue jumped at least 14-fold versus the same period a year ago. The company reported a preliminary revenue figure of more than $11.5 billion. Anthropic is meeting with investors ahead of its potential mega IPO. Jane Street's roughly $15 billion loss tied to AI hedge fund situational awareness surfaced as the firm was swapping its existing debt. The Wall Street Journal reporting Jane Street is replacing more than $11 billion in loans and bonds with a new $14.6 billion debt deal. And that is your Bloomberg brief. John.
Vonnie Quinn, thank you. More from Vonnie in about 30 minutes' time. So the headline for the Wall Street Journal this morning, the Iranians have used the last couple of months not to put faith in talks, but to take time to prepare for a bigger fight. Up next, we'll talk about that bigger fight, the prospect of one, as the MOU expires today. Ed Mills of Raymond James joins us next. Check out crude this morning. Check it out over the last week. Last week, Brent up by about 6%. Crude, one down day in the last 9 sessions. Brent crude this morning, $89 and up by 0.7%. The Treasury Secretary has been ramping up the pressure over the last week, talking about an increased economic pressure campaign. ADNOC reporting that turbot ships were attacked just last week as well. You've got the Israeli strike in Lebanon, which is problematic for diplomacy. And then these comments this morning from the president. just moments ago.
Yeah, two things we learned from this. The president says a back channel exists with Revolutionary Guard officials, and he's in no hurry. He also is warning that if Oman gets in the way, he's going to bomb them. And we know that Oman and Iran have for weeks, we should have already been seeing this. People were excited about this. But for weeks, they've been talking about some sort of understanding to reopen the Strait of Hormuz, and it hasn't materialized.
Tyler Kendall standing by in Washington, D.C. We can cross over to Tyler right now. Tyler, on the one side, you've got the back channel with the Iranians, which I guess is bearish for crude. And then on the other side, you've got the threat of escalation on Oman and threatening to bomb them. Tyler, just frame the current situation for us on the day when the MOU between Iran and the US expires.
Well, John, this is a significant threat from President Trump when it comes to Oman, saying that the U.S. would be willing to bomb them if they, quote, get in the way, in his words. Keep in mind, though, this comes on the heels of this weekend when we heard confirmation from Iran and Oman that they have established what's being called shipping maps that would help to guide ships through the Strait of Hormuz. The context to that being that Iran had been growing increasingly frustrated with ships using the U.S. coordinated route that would hug the coast of Oman and get them further away from the coast of Iran. There had been talk about maybe ships using that middle passage as it's known, but concerns also there about whether or not there are still mines that have been laid in that route. I will say that frustration with Oman has been building in this administration at this point for months. Back in June, before I headed to the G7 summit, a senior administration official who briefed us ahead of the trip said that the U.S. was frustrated between talks with Iran and Oman, instead touting partnerships with other regional allies like Saudi Arabia, Qatar, and the UAE being more palatable partners for the U.S. to work with. John, we'll have to see where it goes from here because, as you and Annmarie are outlining, at the moment there seems to be risk for escalation as the conflict continues to broaden, with Israel conducting those strikes in Lebanon over the weekend, it says was in retaliation for attack by Hezbollah.
Tana, thank you. Stay close, of course. Looking for more breaking news throughout this morning. Ed Mills of Raymond James joins us now for more. Ed, welcome to the programme. There was a school of thought. We've talked about it many times that by the time you got to September, this was over. You needed to refocus minds in Washington on the midterms. Doesn't feel that way, Ed, as we close out
No,
August.
absolutely not, John. I was struck. I spent last week at a Raymond James energy conference where we had top energy kind of management teams. We had a lot of geopolitical individuals. We had a lot of investors. And I think the universal view there is this is going to go on for a really long time, that there is no real resolution. And one of the big debates is, when does Trump declare, quote unquote, victory and move on? That the Iranians are not really interested in negotiating something that gets this done before the midterm elections. What I have been warning clients at Raymond James is after the midterm elections, I think that this has a really high risk of escalation, because what is the thing that holds Trump back at that point? But I'm getting more and more questions from investors. Well, do we actually have to wait until after the midterms before we see a significant escalation? Or is it going to happen regardless of the election calendar here, John?
Well, don't you think the Iranians want to have a more kinetic fight with the United States ahead of the midterm elections as opposed to after? I mean, they have been upset with Trump since Qasem Soleimani in the first administration.
Yeah, Annmarie, I think that there is a kind of a push-pull thought here, is that do the Iranians get the best deal in the lead up to the midterm elections and they're kind of holding out for something? Or are they trying to extract as much political pain for President Trump? And I don't think we truly have an answer to that. To me, I just look at how far apart both sides are in terms of, what the Trump administration is trying to achieve, what the Iranians are willing to do. These reports that, Iran is going to, look at any type of ceasefire as a way of building up additional capacity. So where we've seen so many clients feel as if this was going to be short term, we've said it's not, thinking that this is going to be limited around the midterms. It's not. It's going to get resolved sooner rather than later. It's not. I think we are in this loop of where we have bombing, ceasefire, negotiations break down, and a resumption of bombing. And as long as there's those off ramps, and this is what President Trump's talking about, there's back channels, the market kind of looks through this. So it's really a question of what needs to change for there to be a significant market event here. And it would need to have significant escalation without that off ramp.
Ed, you mentioned in your first answer that at what point are you looking at that Trump could just declare victory, because the midterm election is just declare victory and wash his hands with this conflict. But can he do that if the Strait of Hormuz is closed?
No, and I think that's the biggest issue here. And I do think that all these other issues, the Iranian nuclear program, the ballistic missile program, proxy groups, all of that's really hard to verify. But traffic through the Strait, that's the most verifiable point, and that's why there's so much focus on it. I do also hear from a lot of these energy companies, there is so much effort to deprioritize the Strait, but that's going to take some time. So does Trump start talking about all these other efforts and how the Strait is no longer as important as Iran wants it to be? That might be the only off-ramp in that scenario, Annmarie.
How much is this going to play in the midterm elections? Because we have seen in some recent polling that his numbers are suffering even amongst Republican voters.
Yeah, anything that escalates from here obviously is another drag on Republicans. One of the big debates is the Senate. Does the support for the president have to drop from here? Something we've looked at a lot at here at Raymond James is how much can a candidate of a president's party outperform? The best midterm outperformance we've ever seen was in 2022 with Democrats under Joe Biden, where they outperformed almost 11 percentage points. So if Trump is in the mid to high 30s, Republican candidates, if they outperform him by that percentage point, they win. If his approval rating drops to the mid to low 30s, that's a flashing warning sign, and that's where you would get a Democratic Senate out of these midterm elections.
Just going back to the midterms under Biden, we all remember the runway into that, and it felt like things were really going to go against him quite aggressively. Because of a cost of living crisis, we were talking about high inflation, what was happening with energy, and they were really trying to work hard to do something about it. Didn't succeed much. At this time around, because we got that wrong, they didn't get battered at the polls in the way we expected. This time around, are you thinking about things the same way potentially, that maybe people are getting things wrong about what's going to move the dial in November?
Yeah, I mean, one of the things that we've looked at, John, and why we've continued at Raymond James to give Republicans the more likely chance of retaining the Senate is that has our politics changed, that certain states just vote for certain candidates? Republican states vote for Republicans, Democratic states vote for Democrats. And when we look at kind of how these states that are competitive voted in the presidential election in 2024, you would need 2/3 of those states in the competitive seats to switch over and vote for Democrats. That's never happened before. Usually about 20 to 30% of states are willing to switch their performance. And then if you look at states that voted by a presidential candidate by 10% or more, it's been 2018 since a state has swung that much between the presidential race in the midterm elections. We need to have that happen 4 or 5 times, something that hasn't really occurred in almost a decade. So has the structure of our politics changed enough that even in a very difficult year for Republicans, those Republican candidates go over the finish line because of the kind of structural advantage of those parties within those states? So we're very cautious not to say, oh, because there is a negative environment for Republicans or for President Trump, that is going to create a blue wave. We need to be very cautious against that.
Did I just get sucked into having a conversation about the midterms?
Yep.
I think I did.
You could have asked about something else.
Yeah, I know.
There's other things that focus on. See?
I'm trying to avoid it.
It's exciting, isn't it?
I don't think it is. Got drawn in.
It's going to be good.
Ed Mills of Raymond James. Ed, thank you, buddy. Appreciate it. Up next, Muse of Cantor Fitzgerald saying all in on Nvidia ahead of next week's earnings report. From New York City this morning, good morning. You're watching Bloomberg TV. Equities firmer by 0.1% this morning on the S&P 500. On the Nasdaq up by 0.5, adding to a 3-week winning streak on the S&P and the Nasdaq, the longest stretch we've seen going back to May. I mentioned it earlier this morning, the Nasdaq over the last 3 weeks higher by 7%. So many people looking at situational awareness and the issues they went through a few weeks ago as a so-called clearing event for this market, for people to reposition and get back into the tech story. The tech story again this morning, performing. Let's get you some single names, some morning movers. Yahira has more. Hey, Yahira.
Hi, John. On the tech front, we are seeing Amazon's shares gaining in the pre-market, up more than 1%, looking to snap a 4-day losing streak. The mini rally comes after 13F filings revealed Joshua Kushner's Thrive Capital built a roughly $215 million position in the company. And the reason this is significant is Thrive is usually known for its private investments in companies like OpenAI and SpaceX, but it comes after we've seen very strong momentum behind Amazon after we know in its latest results, AWS posted its fastest growth in more than 4 years. And more from those 13F filings, we are seeing both Intel and SpaceX gaining in the pre-market. And this is after Nvidia disclosed massive stakes in both those companies, $30 billion in Intel, $21 billion in SpaceX. SpaceX also getting a slight boost, still positive, after it was revealed that Australia's richest person, Gina Rinehart, bought 8 million shares in the second quarter, and Harvard also disclosed positions. And we are seeing Snap shares plunging 7% in the pre-market, and this is the biggest loser in the pre-market this morning. And there are a few things hanging over this stock. You've got a growing legal overhang around social media addiction lawsuits, along with some recent insider selling, and the stock is down more than 30% year to date. John.
Plagued by problems, Yahara, thank you. It's down 7 so far this morning. On our radar this morning, one of our top stories over the weekend and into Monday, Anthropic reporting a 14-fold spike in revenue for the second quarter. According to documents seen by Bloomberg, the cloud maker is telling investors preliminary revenue rose to $11.5 billion ahead of a potential mega IPO later this year. Elsewhere, Alibaba's AI models accumulating more than 3 billion downloads in the last 6 months. The Chinese tech giant surpassing Meta and Google to become the world's #1 AI model. And finally, the president ordering the Pentagon to reduce joint military exercises with South Korea, citing the cost and his, quote, very good relationship with the North Korean leader. Trump adding that South Korea has failed to show support for the war with Iran. The president lashing out in the last 24 hours.
Yeah, he has been lashing out. When it comes to South Korea specifically, what the president is doing is using a military commitment as leverage. Maybe this will be a carrot and stick approach. And in some ways, it is working with South Korea in the sense that we have gotten a statement for the presidential office saying it's now in discussions with the U.S. regarding its practical and military contributions related to Iran and how they've been paying close attention to Trump's post, and they want to have this discussion how they can help. On the other side, this is going to really turn the hairs up of the backs of a lot of leaders in Asia, especially given the fact that you have a U.S. aircraft carrier also now leading the Asia Pacific. Is the United States turning its back on the Asia Pacific? No, but with comments like this and what's actually going on in the region, there's going to be cause for concern.
It's hard to keep up this morning with regards to what's going on in the region, not just going after the Koreans, also going after Oman too this morning, just moments ago.
Right. The president telling Fox News that Oman needs to basically get out of the way or that he's going to bomb them. Oman plays both sides. They play with Tehran. They also have discussions with the United States. The president is probably likely just trying to get the Strait of Hormuz open and putting some pressure on Oman, which is why you pointed out you don't see the crude market actually reacting to that very hot rhetoric from the president.
You don't see it reacting at all. We're higher by 0.5 on Brent, 89, around 83 on WTI. This equity market has looked through a lot of stress in the Middle East, and tech continues to rally this morning. Let's turn to tech. The hyperscaler debt binge continues. Sources telling us here at Bloomberg, Alphabet is looking to raise $3.6 billion in its debut bond offering in Australia. Mandeep Singh of Bloomberg Intelligence joined us now for more. Mandeep, the capital demands are huge. And as far as I can tell, so far, Mandeep, this market's still open for business.
It is, and especially for hyperscalers who probably have been the most aggressive that I've ever seen in terms of, capacity expansion, building data centers. And Alphabet, to my mind, even among the hyperscalers, has been more aggressive compared to the likes of Microsoft. And, there's a reason for that is their TPUs and what they are able to do with their own chips, in addition to what they are doing with LLMs and, everything on the cloud. So it sort of makes sense. And the other aspect to this is what Nvidia seems to be doing with SpaceX is they're helping SpaceX ramp up to become a hyperscaler But really, all these hyperscalers need to be aggressive right now because that's how you grow revenue on the cloud. And to my mind, it makes sense that Alphabet has issued equity and now they're raising debt wherever possible.
So we've seen it across multiple currencies, Mandeep. We've been talking about it. We've seen some major US debt issuance as well. And we've seen a big equity capital raise too from this company. Mandeep, do you expect to see something similar from other companies, given that the IPO window's reopening around September time, getting into the fall? We should hear from Anthropic. We might hear from OpenAI as well on that front. Do you think some of those big names get in ahead of them in the same way that Alphabet did to, say, SpaceX? Do you expect to see some activity on the equity side from a big player like a Microsoft who might look to raise some capital?
Probably it could be Microsoft, but I think the difference here is Alphabet has got this whole chip line with TPUs that they could ramp up. And right now we know everyone wants to procure, the accelerator chips, the data center capacity. Microsoft is more of, the customer for those chips. They don't have their own chips. They don't have their best LLM. So from that perspective, they are somewhat in a weaker spot than I would say Alphabet. And same thing for Amazon. Yes, they have the largest cloud, but they don't have the model or the chips like Alphabet does. So from that perspective, I think Alphabet does have a strong position, which is why they are becoming more aggressive with regards to these debt issuance.
Mandeep, got it. It's good to catch up as always. Mandeep Singh there of Bloomberg Intelligence. Let's build on it. Hyperscaler capex fueling optimism in the chip sector. CJ Muse of Cantor Fitzgerald is bullish on Nvidia going into next week's earnings, writing, "We remain all in. The cycle is elongated, supporting far greater duration than the market currently thinks." CJ joins us now for more. CJ, if you can build on that a little bit more, because I think this is important. What do you think the market's missing about the longevity of this cycle?
Yeah, good morning. Yeah, thanks for having me. I think that is the key. I mean, the fears around Nvidia have been circularity around financing, and also to the earlier comments around competition from custom silicon. But I think if you take a step back, compute is sold out. TSMC is by far the biggest bottleneck. That, in my mind, leads to an elongated cycle where we are sold out already. All of 27, backlog building 28, and I would dare say 29. And I think that, from an Nvidia stock perspective, the shares really haven't done anything this year. And they're going to earn $15, $16 next year. So you're paying 15 times today for the leader in AI. That just seems way too cheap in my mind. And I think the catalyst, or one of the catalysts, will be the understanding that this cycle has legs.
CJ, you're alluding to it. Ultimately, you're giving me what you think. But why do you think the stock has done very little in the face of massive spending plans we've seen only increase from these companies? And even as they go negative free cash flow, the willingness to borrow in the debt market is sky high. In fact, it's insatiable. Even if there is a little bit of pushback, they keep on coming in. And those companies are going to keep on spending, keep on buying chips from the likes of Nvidia. Why is the stock doing nothing in response to that?
Yeah, it's a great question. I think there's a couple themes to think about. Number one, the multiples for compute and memory in aggregate are quite low. So it's not just NVIDIA. It's Broadcom, it's Micron, it's SanDisk, et cetera. Point two, specific to NVIDIA, I think that you are seeing increased competition from internal custom silicon. So Google and Amazon are the two largest there. And I think that worries around their market share for inference silicon going forward is a concern. Now, I think very importantly around financing the GPU market and the announcement from NVIDIA and the likes of BlackRock, Apollo, et cetera, are highlighting a new competitive moat for NVIDIA where they are going to create a financing platform to offer the lowest cost of financing and essentially make the financing of the GPU fungible, make it more like an asset-backed class security. And I think that they're going to make this a multi-trillion-dollar financing vehicle. And so when you go with NVIDIA, you're going to get the lowest cost per token per watt. And I think going forward, you're going to get the lowest cost of financing in the debt markets. And that will be another competitive advantage for them that I don't think the market is giving them credit for yet today.
CJ, there's not just competition in the United States. We actually have seen as well Chinese domestic alternatives really ramping up in terms of how quickly they are scaling. Are you concerned about Nvidia, which still sells some chips in China, losing some of that market share?
Well, I think there's two parts to that question. The first one is that, China internally is telling, their chip companies to buy locally. And so I think, unfortunately, the ship has sailed a bit in terms of positioning of U.S. chip makers inside China. I think the more important point on the technology front is that the solutions made inside China are just not anywhere near what Nvidia, what AMD creates from the GPU perspective. It's more of a top-down edict you need to buy locally as opposed to a truly competitive solution.
What did you make of Jensen Huang basically telling some of the richest companies in the world that they need to pull their money for this $500 billion financing pool?
I think from Jensen's perspective, he has a view that the compute necessary to bring AI to bear is more significant than really any other sort of investment cycle that we've seen. And because of that, all of the markets are going to need to get together to build the capacity to support this build out. And I think, Jensen, with all of the investments that they make throughout the entire ecosystem, offers the greatest seat in terms of visibility to what's happening in the market. And so I think he's seeing the breadth of compute that the market is going to need. And I think that's what's driving his commentary.
CJ, appreciate it. Still all in going into earnings next week. CJ Muse there of Cantor Fitzgerald. The likes of Nvidia, we say that the stock has done nothing, and then it's still up about 20%. In Nvidia terms, that's like nothing, but it's still up around 20% year to date.
Because the bar is so high for this company, and we continuously see it exceed it. I just wish, and you mention this all the time, wish their earnings was, say, this week.
I know.
They wait to the very end, and we're all just waiting on, the edge of our seat for them to report. I think it's the 26th now, right?
Wrapping up, that stock is going to report in about a week's time. Nvidia this morning higher by 0.6%. Let's give you an update on news worldwide this morning with your Bloomberg brief. Vonnie Quinn has more. Hey, Vonnie.
Hey, John, thank you. President Donald Trump threatening escalation in the Middle East. The Fox News interview with the president saying the U.S. will bomb Oman if the country, quote, gets in the way as negotiations over the Strait of Hormuz stall. Trump maintaining he's in no hurry to end the war with Iran. AstraZeneca is pulling the plug on its clinical trial of one of its experimental cancer drugs. The pharmaceutical company noting the medication wasn't producing better results than existing therapies, the failure increasing the need for a fresh, next-gen lung cancer medicine. In sports, Cristiano Ronaldo is suggesting he will probably retire at the end of this season. The 41-year-old soccer superstar tells Vogue he wants to leave a spectacular legacy. Ronaldo will attempt to reach 1,000 career goals with Al Nassr, where his contract runs until next summer. And that is your Bloomberg Brief. John.
I believe he needs something like another 24. What a career. What a monster of a career.
It would be crazy if he really does retire, right?
Incredible. Feels like it's just been like this enduring feature of this sport for so long. The latest on Cristiano there. Vonnie, thank you. More from Vonnie in the next hour. Next on the programme, rethinking rate hikes.
If they don't get it done by this year, what you'll see a lot of those people do is just push hikes deeper into the baseline path. And I think that might be what markets are missing. Even though the doves kind of win the battle, they can lose the broader war.
Up next, the longtime friend of this programme, Steve Major of Tradition Dubai, joins us next. Mid-August, and we're going to get another double-digit year on the S&P 500, higher by more than 13%, up 19 on the Nasdaq. What a year for earnings. In the second quarter, we were looking for 20% earnings growth. We got 31 so far. Second quarter, year over year. That's a massive year of earnings, just absolutely monstrous. Great story over the weekend on the Bloomberg terminal on this. The best outside of recoveries from recessions that we've seen in data going back to the early 1990s. Earnings season has been that powerful so far this year.
Ed Yardeni spoke about this last week. He said it's no longer FOMO, it's FEMO. Fabulous earnings momentum. And he says every time he sits down and then he upgrades his year-end target, it's because of what the analysts are saying and what corporate executives are saying. And it all comes down to what is happening on the earnings front.
The street is playing catch-up massively.
Yep.
I've mentioned this a few times already this morning. The average forecast on the street right now is 78.50. It's basically where we are on the S&P. And they've been notching and revising those forecasts higher and higher. Saw it from JPMorgan last week. Was that the second upgrade from JP we've seen from them in, 2 months?
Yes. Individuals keep having to go back to the drawing board, and everyone continues to upgrade higher. The issue, of course, is the wall of worry. And that is why it feels like people are on tenterhooks when it comes to these upgrades, because something could happen. There's a lot of brewing risks right now in the world.
There's always something to worry about. The latest, of course, is monetary policy. The 2-year this morning, 4.16. Yields just about unchanged. Under surveillance this morning, rethinking rate hikes.
If they don't get it done by this year, what you'll see a lot of those people do is just push hikes deeper into the baseline path. And I think that might be what markets are missing. Even though the doves kind of win the battle, they can lose the broader war. I don't think we're really out of the woods just yet.
So here's the latest this morning. Traders pushing back rate hike bets to January after a busy stretch of weaker than expected data. Investors looking for more clues with Fed meeting minutes due out on Wednesday. Stephen Major of Tradition Dubai writing, central banks can initiate rate hiking cycles to tame inflation, but underlying debt dynamics ultimately dictate how those cycles end. Stephen joins us now for more. Steve, my friend, it's good to hear from you. It's good to see you.
Hi, John.
Are we on the brink of some
Likewise.
bond market pushback, limiting the ability to hike rates here at some of these central banks?
Well, the focus is Jackson Hole already. I know it's a week or so away, but people are now discussing what's going to come up at these meetings, because it's very often the case that big set piece moves happen at these conferences. I think that you've reported the impact of debt and fiscal dynamics on bond yields and earnings. And I think that you're quite right. It's a bit more complicated than just the debt levels or the fiscal position, because when earnings are so strong, then the risk premium that goes onto the bond yields or the term premium has to be higher. I mean, try explaining to a young person why they should buy bonds when equities keep blowing the lights out every week. So it's quite simple. There's the risk premium, and I think the fiscal dynamics are somewhat worrying. I guess you could say there's an international effect as well on the long end of bond curves here in the JGBs at the moment, but a few weeks ago it might have been gilts or bunds or Australia or something. So I think there's a whole list of factors that are explaining this drip higher in bond yields at the long end.
Steve, can I pick out one? And it's supply.
Yeah.
I remember a fantastic paper that you published a number of years ago. You know where I'm going with this. Bonds aren't potatoes.
Yeah.
Can you talk to us about the importance or maybe the insignificance of supply traditionally to DM sovereign debt markets?
The point of the paper was that the supply gets taken down. Bond yields reflect the policy rate and the expected path of that policy rate and where it ends up. So it should be that all available information is factored into the price. Where I think the model has kind of broken down is with these huge shocks like COVID, where we had a big shift in the level of debt, maybe 20-25% level shift, like GFC in 2008. The thing about it is, John, if you look at the 2-year that you were covering just now, the 2-year is totally explained by the policy rate and where it's going to go next. Just in the space of the last 6 months or so, we've had a move from markets looking for 3 rate cuts to as many as 2 rate hikes in a year's time. So that's a net 5 rate hike move, and that explains the entirety, if not more, of the shift in those yields in the 2-year, even out to the 5-year. It's when you get to the 10-year plus that something else is clearly at work, and those yields don't want to go back below 5% at the moment. And I think there is a supply dynamic, but it's I think it's a bit cheap to say that there's too many bonds around. That's why the yield's going up. I think the explanation is a bit more sophisticated. I think it's related to the performance of stocks, what's happening in Japan. And yes, there is some fiscal risk premium.
Steve, can I add in maybe corporates as well and the rising competition for capital that we are starting to see increasingly in the debt market too? What kind of an influence is that having in a way that maybe it didn't in years gone by?
Well, it's so right. It's so right, John. And in fact, thank you for reminding me of that. In many ways, I include it in the risk premium category. But faced with the choice between a household name that's issuing long bonds that has a very good credit and the US Treasury, where some people are even questioning the credit, when you can get even more yield in that household name electronics company, whoever it might be, guess what's going to happen? So traditionally, you have a crowding out when yields get high enough and the government always gets done. So there shouldn't be a problem. But that crowding out now faces a challenge from other needers of capital. So there is this demand for capital to invest. I think that is part of it as well. So let's add that to the list, John.
Steve, given the reality we're in right now, where does this leave the Treasury Department in terms of their auctions and where are they going to sell debt?
Yeah, well, at the moment, Annmarie, they've got enough data to be comfortable. So we're looking at the covers and the tails and the indirect bids, etc. But we might be getting a bit twitchy further out on the curve, so that the 30-year bonds may not be so much in demand, even when the yield is so fantastically high. So that says cut back the supply of the long-dated paper and increase the supply of the shorter-dated. Now, of course, they're already doing that, and you can't keep doing this forever. So it seems to me that the US Treasury is not doing the US taxpayer any favors by issuing long bonds north of 5% yield. They're doing a great favor to the savers who are able to lock in those yields, but they're not really doing anyone who's paying tax a real favor there. So I think reducing the quantity at the longer end makes sense. I think also there needs to be a bit more fiscal rigor. There needs to be a plan. Because at the moment, it just seems to me there's no accountability. And you'll see that countries like Germany and to some extent Australia, Switzerland, where they've had debt breaks. And even in the UK, I think that there's at least a 5-year plan to try and balance the books somewhat. The US doesn't even seem to have that at the moment. So I think markets would appreciate a bit of guidance on the fiscal outlook.
There is a risk, of course, Annmarie, that this bond market forces that guidance, forces that call for action.
Exactly. And we've actually seen this bond market force the president reverse policy. So but when it comes to tariffs last year, so potentially you could see it again. Twitchy, yippee.
I could talk to Steve all day about fixed income. Steve Major of Tradition, Dubai. Up next, Darrell Cronk of Wells Fargo, Matt Kennedy of Renaissance Capital, Dana Telsey of the Telsey Advisory Group, and Yoder of JPMorgan Private Bank. The third hour of Bloomberg Surveillance is up next.
Things are looking reasonable right now for the equity markets.
The boom is here. The boom is likely to sustain, but so is all the gloom.
There's a lot of volatility under the surface.
We're a bit more cautious coming into September.
We do see the possibility going into the rest of the year and into next year that this market will continue to broaden.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, the third hour of Bloomberg Surveillance starts right now, and your price action scores look like this. Equity futures firmer by 1/10%, building on 3 weeks of gains on the S&P, the longest weekly winning streak we've seen going back to May. On the Nasdaq high by 0.5. In the bond market, things are calm. Things are okay. 2s, 10s and 30s. Yields just about unchanged. 2s around 416, a rally at the front end last week off the back of softer than expected economic data. 10-year yields still leaking, bleeding higher. 10s around 470, 30s around 526 this morning. And crude unmoved in the face of some pretty crazy headlines this morning. Brent crude around 89, up 1/3 of 1%, even as the president comes out and threatens to bomb Oman.
threatens to bomb Oman, which is one of the key mediators, and they're working right now with the Iranians on potentially reopening the Strait of Hormuz. They obviously play both sides. We've seen this in the past, but not just threatening to bomb them, using some very hot rhetoric when it comes to the Omanis. At the same time, speaking to a reporter at Fox News, the president also said there's a back channel with the Revolutionary Guard and he's in no hurry. Obviously, this comes on the heels of a Wall Street Journal report that amongst all this time, and today the 60-day memorandum actually ends, all this time what the Iranians have been doing is rebuilding infrastructure so they can prepare for a tougher, harder fight with the United States.
Brent crude doing nothing. 89 on
Ignoring
Brent.
it.
WTI totally unchanged. 82.40 on WTI so far this morning. Coming up this week, this is your week ahead. So on the retailer side of things, it's a busy week. For everything else, it's pretty quiet. Through the week, you'll hear from 3 big retailers. On Tuesday, tomorrow, you'll hear from Home Depot, the day after Target, the day after Walmart. The Federal Reserve takes on a bigger and bigger emphasis over the next several weeks or so. On Wednesday, you'll get some Fed minutes. The following week, we're already looking ahead to Jackson Hole, the annual get-together in Wyoming for that symposium of the Federal Reserve, and a speech from a new Fed chair, newly minted Fed chair, Kevin Warsh. And so far, the data is playing into the Dove's hands that they can hold in September. The runway into September looks like this. One more payrolls report on the 4th and one more CPI report a week later before that Fed meeting and that decision on September 16th.
And it's going to be a very interesting Jackson Hole because Chair Warsh said it was a blank statement the last time he spoke at that press conference when individuals were starting to question his credibility. But now that we've had some of these dovish prints and they're into the softer prints and they're in the Dove's favor, then potentially in Jackson Hole, he can pretty much say there's still more reason to remain on patent on hold. They care about inflation, but right now the data is on his side.
Twos around 416, 10s around 470. Yields at the long end still elevated. That could be problematic. We'll talk about that in just a moment. Coming up this hour, we'll catch up with Darrell Cronk of Wells Fargo as stocks post 3 consecutive weeks of gains. Matt Kennedy of Renaissance Capital as Anthropic's revenue absolutely surges in 2Q. And Dana Telsey of Telsey Advisory Group looking ahead to big box retail earnings throughout this week. We begin this hour with stocks and bonds steady as investors push out Fed rate hike bets. Darrell Cronk of Wells Fargo writing, expect slower global economic growth and a steeper yield curve through 2027. Darrell joins us now for more. Darrell, welcome. It's good to see you. Let's just take that quote again. So, softer economic growth and a steeper yield curve. How does one inform the other, if at all?
Well, I think the softer growth just pushes back on the central banks wanting to hike rates. We see that here in the Fed. We think the BOJ probably does have to hike to defend the yen. The ECB and the BOE are kind of, in limbo, I would say, at this point. But what's important here, John, is think about this. Since July 29th, the U.S. market, the 2 to 10-year spread was 24 basis points. This morning, it's 53 basis points. It's doubled its spread in, about 6 weeks, 7 weeks? So it is steepening. I think you have to watch that. It's meaningful when the yield curve steepens when rates are at this high of level. Normally when the 2-year is, call it 415, 420, and you get any kind of that move, it's often because the yield curve is starting to turn on you the other direction and maybe even invert. So the fact that you've got the level of rates where they are and the yield curve steepening as well probably are good signals right now.
Darrell, I think it matters what's leading the steepening. Is it led by the front end rallying or the long end selling off? Is it a bull steepener or a bear steepener? What do you see emerging in the months ahead? Because the 10s and 30s piece of the curve has looked a bit shaky over the last month.
They have, and your prior guest even talked about that. I mean, I think the 10s and 30s still are not priced accordingly. When you take the risk-free rate and you stack that term premium that keeps going up, you stack an inflation premium, which I think people are missing the inflation data. Let me just say something real quick here. The PPI headline, the most recent data we had, was 4.7% year over year. The core was 4.2%. We know that CPI headline was 3.4. We know that core was 2.5. Food inflation is still 3%. Services inflation is still 3%, right? So that inflation headline, I think, this is the first time in several weeks this morning, we now have the September hike below 25 basis points. It's 22 basis points as I walked in to do this thing this morning. I think the market's underappreciating the impact of inflation and what has to happen with yield curves. So I do think the short end comes up, but I also think the long end comes up concurrently with it. So I don't know that you get mammoth steepening from here, but I do think the yield curve can the 2 to 10 can go from 53 basis points to 60 to maybe back to somewhere around 75.
Steve, Darrell, just to build on what Steve was talking about in the last segment, Steve Major was talking about yields being higher as a reflection of increasing and improving risk appetite. I think that's important framing, because you can look at the long end of the yield curve and you can frame it one of two ways. I'll give you two ways. The first, you can say it's a reflection of improving risk appetite and a better backdrop for economic growth. The second is that actually it's a reflection of an increasing competition for capital, and the Treasury market's going to keep on getting squeezed and we could have bigger problems. So there is either a boom or some gloom. And Darrell, I do think the framing matters with regards to risk, because at some point, that move at the long end of the curve does become a problem for risk assets. Where is that point, Darrell?
Well, I think the 30-year needs to stay below 550, right? I think anything above that. Remember, as you know well, what's driven this equity market has been nothing but technology, right? The SOX index, the SMH, all that stuff has made this vicious rebound since July 29th. We know that technology stocks are what? They're the longest dated asset, duration asset out there, right? So at some point, they do have to reconcile themselves with long-term rates. And if long-term rates continue to leak higher, again, you have to go back to the source, to your good point, right? Is it coming from the term premium, which is fiscal concerns? Is it coming from inflation, that the market's underappreciating inflation, which I think that might be part of the case? Or is it coming, to your point, from the growth premium expanding? I don't know that you would pound the table and say the growth premium is metamorphically expanding at the economy level. It might be at the AI, semiconductor, hyperscalers, data centers, the AI enablement platforms, cybersecurity, all that stuff might be pushing growth higher at the company level, but you don't see it showing up in the economic data, right? Look at the first half of this year, 2.1% U.S. GDP growth in the first quarter, 1.5% in the second quarter, some trade anomalies in there. We need to see growth move higher to make the good argument that the long side of the yield curve moving higher is coming from a growth premium.
Darrell, you seem more concerned about inflation than others we spoke to this morning. Do you think it's a concern for enough doves to potentially cross the line in September?
I think that, well, let me answer it this way, Annmarie. Should they go in September? I think they should, actually. I think it would be a preemptive, rate hike, and I do think that that's what needs to happen to kind of curb price inflation. We're seeing it at the earliest stages of PPI. Can they get enough people to cross? I don't think that's likely. I think Chair Warsh will talk them into saying, look, we've still got our committee doing its work, trying to figure out how we want to look at this. But to your earlier point, and you made this earlier in the show, the October Fed meeting is October 28th, right? The following Tuesday is the midterm elections.
Yeah, it can't
so that
happen.
October meeting is a really tough meeting to walk in the door and hike interest rates right ahead of the midterms. And then, of course, you have the December meeting, and that's it. So markets are starting to look and say the first hike is in January now, not in September, not in October, and probably not in December.
Darrell Cronk of Wells Fargo. Darrell, appreciate it. Steeper curves and better financials in the equity market. A big call for them this year. The move in the banks really starting to pay off in the previous few months. That call on October, I think, is really important. That the pricing for January, to Darrell's point, may have something more to do with the quirks of the calendar in the midterms than it does with maybe a stake, a bet on what's going to happen with inflation.
If you think the Fed is going to hike interest rates before the midterm elections, it has to be September. I think everyone on that committee knows to not look political, they would have to refrain from doing anything in October. It's just too close to the midterm elections. Can you imagine the Truth Social posts?
Getting sucked into midterm conversations all over again.
So
I'm
this
trying
is
to
why
avoid it.
I'm using the Fed as
I
a
know.
decoy, a Trojan horse, to get you to talk about elections.
What's this, the Odyssey?
Yes.
Now, what are we doing here?
I haven't seen it yet.
I haven't seen it either.
I'm going to.
I hear the people who have gone to watch it have gone back like 5 times.
Yeah, it's supposed to be amazing. I know there's lots of, hoopla.
Hey, look, there always is.
About it on Twitter, but
There
the
always
cast is incredible.
I'll check it out at some point. Let's give you an update on news worldwide with your Bloomberg brief. Vonnie Quinn has more. Hey, Vonnie.
Hey, John, thank you. President Donald Trump threatening to bomb the country of Oman if it gets in the way of the US and its war with Iran. The president telling Fox News there have been back-channel communications between Washington and the IRGC and that he is, quote, in no hurry when it comes to ending the ongoing conflict. Alphabet looking to raise about $3.6 billion in its first Australian bond sale, with price guidance possible Tuesday and pricing as soon as Wednesday. Shares a little higher in the pre-market as the offering tests appetite for big tech debt amid a wave of AI-fueled borrowing. Andy Burnham reportedly exchanging messages with someone impersonating White House Chief of Staff Susie Wiles. The Financial Times reporting that the conversations were by message, not a phone call, and that no significant information was conveyed in the messages. And that is your Bloomberg Brief. John.
That is filed under not good. Not good. Bonnie, thank you. More from Bonnie in about 30 minutes' time. Up next, the morning calls, plus Matt Kennedy of Renaissance Capital as Anthropic reports a massive surge in revenue. That conversation just around the corner. Live from New York City this morning. Good morning.
The commentary we've been continuing to hear is value-seeking behavior, sort of the pressures from the low end creeping up to the middle end. We're going to have to see what we get, but I would say that the kind of theme of resiliency, I think that's going to be a hard one to break.
That was Laurie Calvasina of RBC on retailers and this consumer. Retail sales into the weekend on Friday really soft. Is there anything worrying here? I think some pushback from the team over at Bank of America in the Consumer Checkpoint report. I shared this quote earlier this morning. It's worth repeating. The share of households paying off their credit card bills in full each month has risen. It's not declined. They go on to say there is little sign of an acceleration in households drawing upon their savings. This is important stuff. They've got access to data, the credit card spending, the balances at Bank of America to really sift through month on month and try and separate facts from feelings. I know the feelings around this economy are not great, and for good reason right now. But if you're tracking things in real time in the data, that's the latest from Bank of America.
Vibe's not great, but the real-time data, according to Bank of America, is fine. It is a big deal if you see households paying off credit card bills in full, not having to tap their savings. And according to the report as of last week, the K is converging. That is a very good sign for this economy.
So retailers through the week will give us another glimpse, some more insight into the consumer. We will hear from Home Depot tomorrow, Target Wednesday, Walmart on Thursday. Let's get you some morning calls. First up, Stifel raising its price target on Home Depot, citing relative strength and pro-market optionality. A second call from Wells Fargo raising its price target on Dollar Tree, expecting the company to raise its full-year guidance. And finally, Rothschild & Co. Redburn upgrading Apple to buy with a street-high price target of 400, forecasting sales growth from a reported foldable iPhone. That stock is up this morning by close to 0.5%. Not too excited about that?
I don't know. Why do we need a foldable iPhone? Why?
Maybe it's to get that newness involved in the product lineup.
Butt
to get
dials.
people to
You think
upgrade.
that'd be harder?
Dan Ives has been talking about that upgrade cycle, that elusive upgrade cycle. People just sitting on old phones, iPhones, on old
Just bring back
iPods
the BlackBerry and I think you'd have an upgrade.
Oh, yeah, you would? Bring back the buttons?
Yes.
Okay.
I love them. I found my old one last
week. Oh, did you?
Yeah.
Did you power it up?
You can't. I don't think you can. I should bring it to the store and say, could you do this?
Bring it in. Apple this morning, up by 0.5. Anthropic telling prospective investors its second quarter revenue jumped at least 14-fold compared to a year ago. The data coming from documents seen by Bloomberg as the company gears up for a potential mega IPO. Bloomberg's Ed Ludlow joins us now for more. Ed, good morning. The company, based on what we've seen, doing all the right things.
Yeah, doing all the right things. So $11.5 billion, up from almost $800 million in the same period a year ago. Maybe the more interesting data point is positive adjusted operating income in the quarter gone. I'm looking at some of the stocks that are moving positively in the pre-market in response to this report. And, in part, the story being a validation of the AI trade, but also in the context of the IPO, right? And what Bloomberg also reports is this. In the month of May, Anthropic hitting annual revenue run rate $47 billion. You can try and compare and contrast against OpenAI's reported $40 billion revenue run rate. They're get calculated differently. There's all sorts of caveats, but based on everything we've reported, and in the context of this being data presented, in the form of documents to prospective investors ahead of a potential IPO, it seems like full steam ahead.
Yeah, there's a positioning story here, and you're reflecting on it, Ed. OpenAI versus Anthropic, who's ahead, who's behind, and in some ways that's also captured by the IPO calendar. We expect Anthropic to go first before OpenAI because in many ways people see that company as being the market leader right now.
Yeah, and they've sort of had a more recent acceleration as well based on those financial metrics that we've reported for Anthropic. The reporting is that Anthropic's looking at October, the fall. I find it difficult to define what the fall means, in the US, but October seems to be it. And the latest reporting was that OpenAI had kind of kicked it into at least the first quarter of 2027. But there is now like a much closer focus to the financial health of these companies because you don't want to see infinite operating losses, even with revenue growth. And, the story of their capital raising in the private markets is quite well told. But again, the situation, the state of play formally is both have filed confidentially with the SEC and both have said that there is no sort of set pressure. There is no absolute on them going public. It is one of a number of financial options available to them.
Ed, it's good to see you. Looking forward to the programme. Bloomberg Tech is about 3 hours away. Matt Kennedy of Renaissance Capital writing, typically we see a big IPO blitz from mid-September through October. That's when we expect Anthropic and possibly OpenAI. These deals could really cement 2026 as the year of the mega IPO. Matt joins us now for more. Matt, welcome. Like for you and the team, this is really exciting stuff, I'm sure. Fall's going to get underway. We're going to see a massive calendar pickup. Can you start with positioning, just Anthropic versus OpenAI? What separates the two at the moment for you?
Yeah, I mean, I think with OpenAI, they've really dominated on the user subscription side, whereas Anthropic has focused on the enterprise. In hindsight, it looks like Anthropic made the smart move there. But, it's still early innings. This is a multi-year play. So beyond strategy, though, I do want to point out this often gets lost. Claude really did have a superior model over ChatGPT for much of 2026. And I think that also allowed them to really accelerate this year. And I think that's reflected in the numbers, too.
Matt, different companies, similar size. We're talking about trillions of dollars potentially across a range of companies coming to market this year. But SpaceX, how do you think the post-SpaceX IPO performance, the post-IPO performance in the stock market might inform the pricing and the approach to an IPO from these companies?
Well, already I think we saw Sam Altman kind of cite SpaceX as a reason he was worried about going public this year. I mean, in the first 2 months of SpaceX's trading, they jumped 50%, lost 50%, and then recovered back to the IPO price, right now trading above it. That is not a pattern that you typically see with these trillion-dollar companies. So I think that's something that investors should be prepared for. It can happen despite their size. It also tells me that we're not in a bubble. I mean, investors did not pay any price for SpaceX. There's a healthy amount of skepticism and price discipline in the market, and I like to see that.
Do you think, given the SpaceX IPO and what we're seeing right now with that company, could mean that Anthropic or OpenAI delay?
No, I mean, I think if it might be a different story if SpaceX was at $110 or sub 100. But now that they've recovered back to the IPO price, I think that's given the market some confidence. And I think that these are such different companies. SpaceX earnings really coming from that NeoCloud story, whereas Anthropic, OpenAI, coming from a much higher quality earnings perspective. Earnings much down the road, but still.
Well, we had a report over the weekend about earnings, about Anthropic told prospective investors the second quarter revenue jumped at least 14-fold from the same period in 2025. Is OpenAI on par?
It doesn't look like they're on par. That doesn't mean that they can't still get a $1 trillion valuation. Maybe Anthropic can get $2 trillion. Maybe OpenAI can get $1 trillion. I think that there will be demand for both. I think the way to play the AI revolution is to buy multiple companies, spread your bets, see which one comes out on top. And I think the market is big enough here for multiple big players. It's not necessarily winner takes all market yet.
That's was going to be my question. When you start saying 2 trillion, 1 trillion, is this market big enough? What is the risk for going second?
I mean, I think that it's We don't know what the market is, but we have never seen this kind of growth at scale before. You mentioned 14x revenue growth. When I first heard that $2 trillion valuation, my eyes kind of popped. But it doesn't sound so bad when they're forecasting, when you hear 200 billion in revenue by 2028, revenue doubling sequentially quarter over quarter. And much of this revenue is, at least from Anthropic, on the back of high quality enterprise clients. This is a sticky revenue base.
Matt, there's massive demand for this, and you've indicated that. And in many ways, this supply is a response to the demand that exists in this equity market. One thing increasingly we're focused on, though, is when the supply starts to inform the demand. Matt, it's not just the IPOs. Of course, you've seen many of these big companies, big publicly listed tech companies, flip from huge capital returns to focused on massive capex cycles fueled by debt issuance, and for some, increasingly fueled by equity issuance as well, Matt. Does that shape the backdrop for these IPOs in any way, shape or form, Matt? When the likes of Alphabet comes out with a monster equity capital raise just before SpaceX hits the market, do you see it informing, those kind of forces informing the way these things price, the way these things trade in the year ahead?
Yeah, I mean, it's a good question. I think the amount of money being poured into the both CapEx and on the subscription side, the API side, is massive. And I honestly, I do think 2026 is where these enterprise customers have started to see the ROI on their investments. The customers of Anthropic are, I think, reporting doubling efficiency. I mean, personal experience at Renaissance, our IT team output has doubled. Their project efficiency is, off the charts. I think companies are finally starting to see.
Matt, can I jump in, because we only have 45 seconds left, so forgive me, I'm just against the clock.
Sure.
When you say that, it makes me wonder, why do they need to drop prices then? Why are we seeing that dynamic take hold?
Yeah, I mean, the competition is going to be a risk factor here, obviously. What happens if a competitor like DeepSeek comes along, offers a model that's just as good at a fraction of the price? But right now, I think that they're just in total growth mode, land and expand, get as many customers as possible, get them hooked, and then raise prices later.
Matt, enjoyed this. No doubt we'll be talking again in September and October and maybe into year end. Matt Kennedy of Renaissance Capital on the big IPO calendar opening up in a few months' time.
It's massive. And the race to get there first, obviously everyone knows it's likely going to be Anthropic, and based off the reporting this weekend, the revenue they're bringing in is unbelievable.
This is the story of the year. Plays into the same theme. It's the competition for capital right now, fueling the massive capex cycle in this economy. Up next, Dana Telsey of Telsey Advisory Group. We'll look at the retail earnings coming through this week. Tech stocks looking good this morning. Reportedly, Anthropic revenue numbers for 2Q fantastic, up 14-fold in the last year or so, 11.5 billion for the second quarter, according to our reporting here at Bloomberg. That's supporting the Nasdaq trade this morning, up a third, just up on a margin, building on 3 weeks of gains, all-time highs coming into Monday, just short of them on the S&P, just short of them by a few tenths of 1%. In the bond market, 2s, 10s and 30s shaping up as follows. Yields at the front end of the curve, 2s around 417, still pinned in around 420 at the moment. It's just the longer end of the curve, just can't get away from 470 on 10s, 530 on 30s. Following more issuance last week, more still to come this week. 20-year bond auction a few days away.
And the auction is going to be interesting because last week's auction, yes, it was decent in terms of the 30-year, but it was the highest yield going back to 2021. And if you're the Treasury Secretary right now or Fed and you see 4.7 on a 10-year yield, you would like it to be closer to 4% than 5%. And what did we hear from Stephen Major? He used the word twitchy. The president used the word yippee. This is what they are focused on.
I just saw Canadian inflation coming a bit harder than expected as well. You're seeing this theme worldwide, rate hiking cycles beyond the US. Neil Dutta wrote to me following our conversation we had with him a little bit earlier this morning, and he talked about what he's seeing worldwide. You've got other economies hiking interest rates, even though their economies are not as strong as what we see here in the United States, making the case, I think, for the hawks at least right now, that there is space to hike if we need to regain some credibility on inflation.
Right, but is the evidence enough for some of the doves in the committee to cross the line in September?
That I don't know, and you ask an important question.
Likely not. That's why Goldman Sachs also thinks they're going to be on hold. They put out a note this weekend that the data is just for the doves is really on their side. And then if they don't hike in September, I think the bar is incredibly high to go just a few days before an election.
You know, when it comes to the bond market, I actually find the monetary policy piece of this the least interesting part.
You think the Treasury?
I think the Treasury and everything else that's happening, the big picture backdrop, and you've got to really take a step back. You think about the anchors that have really held down bond yields. Central banks have been a part of that, big part of that, over the last several decades, but it goes beyond them. You think about the struggle to get inflation in Japan, the fiscal discipline in places like Germany. You think about the massive companies that we've been covering for years, these huge tech firms, that have driven capital returns and have not been tapping equity, tapping debt in any way like they have in the last 6 months or so. And I said a few weeks ago, it's anchors away. All the anchors that have held down bond yields over the last 20, 30 years are away. They're gone. The disinflationary trend of the last several decades turned into an inflationary pop coming out of the pandemic. Japan got what they were looking for. They don't know how to handle it. They've got a problem there on several fronts. Fiscal discipline is over in Germany. They've moved away from that. You mentioned one force that's really important earlier on this morning, and it's the reinvestment in military that we're seeing worldwide. That's a feature in all this as well. That's more supply. Tech firms invest in aggressively, huge competition for capital driving yields higher. I find that far more interesting. That's what's driving the long end of the curves right now, much more than anything to do with central banks. Central banks are a feature, they're part of the story, just not a massive part compared to what's happening elsewhere.
Right. So in terms of the bond market, if they hike, what's it going to do? Maybe nothing, because it's a litany of issues, as you've mentioned, that are happening around the world that's playing in this force.
5:30 this morning on 30s. 1 hour away from the cash open. Let's get you some single names, some morning movers. Yahara has more. Hey, Yahara.
Hi, John. Amazon is looking to snap a 4-day losing streak, with shares up 1.4% in the pre-market. The mini rally comes after 13 F filings show that Joshua Kushner's Thrive Capital has built a $215 million position in the company. And this is notable because Thrive is, of course, known for its private investments in companies like SpaceX and OpenAI. But this is part of its move into public equities, and it comes alongside some of the strongest momentum we've seen in Amazon's cloud business after its results showed that AWS posted its fastest growth in more than 4 years. Meanwhile, those 13 F filings also showing that Berkshire Hathaway significantly increased its stake in Macy's. So those shares are also up about 1.4%. It more than doubled its position in the second quarter. And the news, of course, comes just as retail earnings are set to kick off. Macy's reporting its own on September 3rd, and investors will be looking to see whether it can sustain its momentum amid this turnaround that the company is trying to engineer. It posted a beat and a raise last quarter. And we are seeing L3Harris shares falling nearly 3% after abruptly replacing its CEO. The defense giant saying that Chris Kubasik is out following an investigation into his conduct that was, quote, not consistent with the values of the company. But that's it. No further details on what happened. However, L3Harris is stressing that this has nothing to do with its financials, its customers or operations, and it reaffirmed its full-year outlook. John.
Yahara, good to see you. Thank you. Appreciate it this morning. Investors then pushing out Fed rate hike bets following a slew of softer than expected economic data. Wall Street now awaiting FOMC meeting minutes due out on Wednesday. Bloomberg's Enda Karen joins us now from Washington for more. And let's start with the economic data, and then we can talk about the minutes that are coming later this week. On the data front, softer on payrolls, softer on PPI, softer on retail sales, and yet the hawks are still hawkish going into next month. And can we make sense of that?
I think you're right, John. It feels like a lot has changed over the past couple of weeks, even on the economy. The jobs data coming in, not just softer for the month, but those revisions kind of starting to undermine ideas that maybe the labour market was as stable as people thought. Then, of course, as you mentioned, we had the inflation data. And, of course, you can slice and splice it every way. But, you know, broadly speaking, especially looking at the core numbers, it seems like the tariff story is finally coming off the boil, not really seeing that energy spillover that people had anticipated. Of course, there are pockets of inflation, absolutely, but maybe heading in the right direction slowly. And then, of course, retail sales also, like you mentioned, on Friday. And you stack it all together, and you'd have to say, at the very least, it doesn't lean into the hawkish case to raise interest rates in the near term, at least. But we do have more numbers on the economy before that mid-September meeting for the Fed, John. We will get more readings on the labour market and on inflation, and I think those numbers will probably seal the deal one way or another.
And there is an opportunity to so-called massage the minutes if they want to. I'm not saying they're going to mischaracterise what was discussed in the meeting, but maybe just put a little bit more emphasis on one or two things. Given how the news conference went, what the fallout looked like in the days after, and the fact that sources around the Fed chair spoke to the Financial Times to re-clarify a couple of things, where would you expect the emphasis to be in these meetings coming later this week?
Well, I think most people reading these minutes, John, will want to see detail on how robust the discussion was. I think Chairman Walsh used the word robust in terms of how he summed up the discussion back then. We know we had 3 dissenters. Obviously, that means there are probably some silent dissenters behind those officials too. How broad-based was the feeling that borrowing costs need to go up in the near term? So I think people will be looking for the minutes to capture that sense of urgency or not. And if that's kind of diluted, I think there'll be a feeling of disappointment as a result. The other thing, by the way, John, in these minutes, even though they feel stale because the economic numbers have moved on so quickly since as we discussed earlier, there will be a wrinkle in these minutes on the discussion around the number of meetings and the cadence and frequency of meetings that the Fed may have next year and in the years ahead. This was a suggestion that was brought in towards the end of the meeting by Chairman Walsh, some brief discussion on it that we were told. So let's see if there's much detail on that and see how broad-based the support is or not for a shake-up of the Fed's policy schedule as well.
Interesting. And thank you. A lot to look for on Wednesday. And Karen there. A lot to look for in this economy as well. Retail sales on Friday was soft. We'll get another look later on this week. We've got a slew of big box retailers reporting this week. Walmart, Target, TJX among the companies set to give new insight into the consumer. The results coming after July retail sales dropped the most since May of last year. Dana Telsey of Telsey Advisory Group writing, we should hear some progress on the back-to-school season, planning for holidays, tariff plans and the health of the consumer of all income levels. Dana joins us now for more. Dana, welcome. Want to pick out one name for the week ahead, and that one name is Target. Target this year is up 60% year to date. It has been a dog for the last 4 years, bruised, battered, and now we've got a bounce. Dana, new leadership, what are they doing to turn that story around to help this stock?
You take a look at the transformation strategy that they're putting in place in so many different ways, whether it's enhancing the customer experience, whether it's leveraging technology, including AI, whether it's recapturing the merchandising muscle that they had in the past, whether it's the collaborations that they've put in place, you're seeing newness. And I think you're also going to see it even more in the stores as they're remodeling nearly 100 stores in 2026 and going on that new store opening pace of around 30 a year. So the focus is bringing back the magic of Target, and we've seen improvement in the stock price through this quarter.
Right, and you're calling it the magic of Target when people felt like this was actually a premium brand. What does this mean for its competitors then, if this is where Target is going in that direction?
Well, you look at everyone else, whether it's the Walmarts of the world or the off-pricers, there's enough for all of them. With Walmart and their focus certainly on technology, on AI, with frankly the enhanced muscle that they have, whether it is in their product assortment, whether it's in their locations, look what they have with Sam's Club. You never count Walmart out. And you take a look at the off-pricers with TJX, with Ross Stores, with Burlington, you have the expansion of new store openings at Ross Stores along with enhanced product. You look at Burlington and their 2.0 strategy that they've put in place and they've seen improvement. Just look at the store that they opened in Manhattan, downtown in Chelsea. And obviously you look at TJ with their certainly diversification of category strength with home goods and the muscle that they have there. There's opportunity because of the trade down customer that the off-pricers get along with their existing customer base.
Dana, in June, the CEO of Walmart said that higher fuel costs are weighing on profit and could potentially mean that they would have to raise prices. Do you think we're going to see that?
Keep in mind that gasoline prices from then until now have come down. I think also you're seeing that it continues to be a competitive environment. I think the basics is where you're seeing all types of companies play for value. I think the newness and innovation is where you're seeing a little bit higher prices than what you normally would see because there's no comparative.
Dana Telsey with the latest out of Telsey Advisory Group, looking ahead to these earnings later this week. Dana, thank you. Looking ahead to numbers from Target, Home Depot, Walmart. That's a pretty decent read of what's happening in this US economy right now through this week.
She also said that individuals have been trading down, a different word for maybe saying choiceful. More people are going and
seen that trade down. You know, that's been a story for Walmart, and they've captured that story for a number of years now.
Yeah, and for Target, maybe they are getting their mojo back, doing some of these very cool tie-ups with different brands like Love Shack Fancy. They do Pokemon. Years ago, they did Mazzoni. It seems like maybe it's cool once again to shop at Target.
Took a while. It's been brutal for that
ages.
company. So many issues.
Really bad.
Massive year so far. Let's see if they keep it up. Let's give you an update on stories worldwide this morning with your Bloomberg Brief. Vonnie Quinn has more. Hey, Vonnie.
Hey, John, thank you. The U.S. Navy awarding Raytheon a contract valued at $22.9 billion to accelerate production of Tomahawk missiles. The Pentagon working to restore inventories of interceptors and long-range precision missiles that were depleted during the ongoing war with Iran. Jane Street's roughly $15 billion loss, tied to AI hedge fund situational awareness, surfaced as the firm was swapping its existing debt. The Wall Street Journal reporting Jane Street is replacing more than $11 billion in loans and bonds with a new $14.6 billion debt deal. Ferrari's first all-electric car sold for a record-breaking $40 million. The Luce became the most expensive new car ever sold at an auction. The car maker is expected to sell out of its initial run of several hundred units. And that is your Bloomberg Brief. John.
Bonnie, thank you. You just want me to bite, don't you?
I want you to say that was me. I bought the Luce.
Yeah, right. If I had that kind of money...
That would not be the car you were buying.
That would not be the kind of car I was buying.
No.
No.
Well, hope you buy me.
Oh, I wouldn't be here either.
Yeah, it would have not be that car. I would love to know who bought it. And I would love to know why. What are they after with Ferrari?
Motives is what I'm interested in here too. Look, some people will buy it because they like it. I'm sure that's true. But I think that the motive, I do think there is an overwhelming motive to get in the good grace of Ferrari and stay in the good grace of Ferrari because they want access to limited edition vehicles.
Yes.
That are not called the Luce.
Exactly.
Okay.
I 100% agree.
Yeah. Not a unique argument. I think a lot of people see it that way. Up next on the programme, setting you up for the day ahead. Plus, we'll catch up with Yoder of JPMorgan Private Bank as stocks look to return to record highs, building on a 3-week winning run.
There's a whole list of factors that are explaining this drip higher in bond yields at the long end. It's related to the performance of stocks, what's happening in Japan, and yes, there is some fiscal risk premium. We might be getting a bit twitchy further out on the curve, so that the 30-year bonds may not be so much in demand, even when the yield is so fantastically high.
Twitchy is the right word right now. That word came from Stephen Major of Tradition Dubai, weighing in on the moves we've seen in the bond market and the auction last week on a 30-year maturity, the highest yield we've seen at auction for a 30-year, going back to 2001. And yields are still sticky high. They are sticking to around 525 to 530 on 30s. We're at 528 this morning. On 10s, around 471. Over in Japan, on one tenor at least, we saw the highest yields we've seen going back to the 1990s over in Japan and the Japanese debt market. So this is certainly not unique to the US. There are some global forces at work here, pushing yields higher, and we're staying at these levels for longer.
It's not unique to the U.S., but obviously this is definitely going to be a problem for this administration that wants to get bond yields down. 4.71% on the yield in the 10-year. It's closer to 5 than 4. This is not the direction of travel the Treasury Secretary wants.
Look at what you're fighting right now. You're fighting Japan and what's happening with JGBs. You're fighting Alphabet and all the issuance we're seeing from the major tech players right now. We're fighting the forces you discussed earlier this morning. The investment back into the military, the debt that's being issued across a range of economies to finance that. You're fighting all these forces you have very little control of right now if you're at the Treasury.
And countries that are going to tap more for all of these issues, including the defense issue. You have our own government, the United States military, coming out and saying they need 1.5 trillion.
It's 1 trillion now, and it needs to be 1.5.
Right. And our net interest expense just continues to grow and has actually surpassed our defense spending.
So if you need corrective action in Washington right now, where's it come from? Right?
That was what Stephen Major was saying. He said, I thought it was great when he said, even the UK has somewhat of a plan.
So Steve's point is that the bond market is telling you right now, stop issuing 30s, right? That's what the bond market is telling you. But they have been reducing the amount they issue at the longer end of the curve as well. That started with Yellen. So that first move is the big move, and that's where you get the biggest bang for your buck when you tighten up issuance that way. You can carry on doing it. Maybe you can bring it in even more, cut issuance at the long end even more.
And that's what many are expecting this Treasury Secretary to do, even though he was very critical of the prior administration and Janet Yellen of issuing on the short end.
So this is the week ahead. It looks like this. You get lots of retailer earnings. We've talked about a few of them, including Home Depot. Get some Fed minutes as well. Get some PMI data on Friday. Also in the mix on Wednesday afternoon, a 20-year debt auction. The 20-year, a bit of an orphan on the yield curve. Trades a little bit weirdly, let's put it that way.
That might be a twitchy one.
Yeah, look, I don't think you can read too much into how the 20-year trades or what the auction looks like, but people will look for it anyway on Wednesday. So much so that Bramo's going to come back Thursday morning so she can talk about it.
I was going to say, is Lisa's back Wednesday or Thursday?
She's
Perfect.
back Thursday.
She can take over.
Get the results from that auction Wednesday afternoon. Let's talk about equities looking to return to record highs following 3 weeks of gains. Abby Yoder of JPMorgan Private Bank writing, our mid-year target remains 7,800, 8,200 at the midpoint. Our favourite ideas right now are semis and banks. Abby joins us now for more. Abby, good morning.
Good morning.
What's there to like about chips at the moment?
Well, I mean, there's a lot to like, right? I feel like over the past couple of weeks, we continue to get data that just suggests that this infrastructure build out continues to be very, very strong, right? We got the reports from the hyperscalers that were just kind of through the roof in terms of what everyone really wanted to see in terms of AI monetization, right? We saw a 9 percentage point increase quarter over quarter in their AI related revenue, and that's what everyone wanted to see. You also saw their backlog for those revenues increase 150% year over year to $1.7 trillion, right? That's basically contracted revenue for 2 years, right? So when you think about where that's going, it's going to these semiconductor stocks, right? And there's still very much a supply issue. So you put those two things together and it just seems like there's still runway.
The financing for it as well is a major piece of all of this. We noted Alphabet, the reports here at Bloomberg suggesting they'll tap the Aussie debt market, so-called kangaroo bonds. I love the names for this stuff.
Down under.
This is a massive, massive story. And it underpins a lot of the spending taking place right now. Is there a lot of runway for this to carry on at the rate that it's carrying on?
Yeah, it felt like a hard pivot that you were like, okay, let's talk about equities because the bond market is what everyone is really, to your point, it's twitchy, right? And the equity market is not. It's at all-time highs. And so I think, yes, look, there is room for this to continue. Like coming into this year, remember, this wasn't even a conversation. Like the hyperscalers raising debt to spend this money was not a conversation 12 months ago, right? So, and it was all about how much cash they have on their balance sheet and they have these net cash positions. So even when you look at them relative to the rest of the IG market, they're really in a better balance sheet perspective, right, or position. So going forward, yes, they certainly still have that runway. And also, you know, as we all know, they're not just tapping debt markets, right? They're tapping equity markets. They're doing all of these different things to finance that have runway going forward.
Is there a point, though, where these twitchy bond yields start to impact the equity market?
Absolutely. I think most important is the speed at which it moves, right? But we even saw that this year, like that quick move earlier in the summer, and the equity market digested that relatively well. I think that's because fundamentals just remain so strong. But I do think there is this psychological threshold at 5% on the 10-year that becomes just, wait, can I take that risk in bonds, right? Because everyone's been so burned over the last 4 to 5 years on bonds that it's like, you know, there's a price for everything, just like for the equity market. And so when it gets to that 5% level, I think it becomes much more of a conversation like maybe I can allocate some of my portfolio there, whereas in the past couple of years, that's just been kind of off the table.
When it comes to semis, you've outlined all the momentum behind this trade. Are you concerned, though, like we saw today from Alibaba, how big these open models in China are growing?
So I think there was some really good data over the last couple of, over this weekend actually, talking about usage in terms of, you know, the closed weight models from the AI labs in the US, and the token spend and the actual overall spend continues to increase. So it seems like what companies are doing, which is like kind of the whole premise, right, is they're using those open weight models for various tasks that are probably, let's call it like low impact to a certain extent. Not low impact, but not as like intense from, like a thinking standpoint. And so they use them for that because that's more cost effective. And let's be honest, these are not free by any means, right? You have to build upon them, and that actually takes a lot of upfront money. And then they're refusing to give up these like closed models coming from the US because they're so far in advance from a technological perspective that they really don't want to lose that edge. I mean, think about that from like a company standpoint when they're thinking about that. Like, do I really want to give up that license right now and just go to these open weight models that like, yes, I can manipulate them to my liking, but like they're not on my API, and like I don't know that there is like high tech as these other things. So I just think there's a gravitation because we are the US, like that we want to be at the top, and that's what we're going to continue to spend money on.
Can you clarify something for us? Are the frontier models entering what looks like a price war?
It does seem like it. And that's not just from China, right? Because you do have a couple of open weight models in the US. One was announced last week that are much more competitive and the low cost, right? And I think this is how I actually think this AI like market is similar to what's happening with GLP-1s, right? Where they started so expensive. I love this. And then now they're coming down in price, but so many more people are using them that you're actually seeing a decline in the obesity rate in the United States already. Like, this is like 2 to 3 years into this, but and you look at those one company in particular that continues to beat $2 billion every quarter. Like, the fundamentals are still there. Like, it feels very similar in corollary to that.
What about the stock performance?
So, in terms of the semis.
Well, if you want to take that corollary, if you want to extend it, right, the stocks at some point started to struggle too, even though the adoption of the drugs was pretty decent.
Well, I think that's where you start to see maybe a handoff from the semis to the hyperscalers. I think we're in a moment where you see both of them work together, which was a disconnect that couldn't be sustained, right? The fact that you had semiconductors outperforming and hyperscalers really like underperforming, and they're the ones kind of funding this, that's problematic, right? Like, that's .com-ish. And so when you get I think right now we're in this period where you get them to work together because you're seeing that return on investment for the hyperscalers. And then I think what you're describing would be the hyperscalers then outperform.
Abby, appreciate it. It's good to see you. Abby Yoder there of JPMorgan Private Bank, live from New York City this morning. Good morning. Thank you for choosing Bloomberg TV. We'll see you tomorrow. This was Bloomberg Surveillance.